Ladies and gentlemen, welcome to the Midday Market Monitor. We're changing it up a little bit on the timing here today. We're going live at noon all the way through probably till about 4 or so. We'll see what ends up happening, but got a couple different things that I want to cover today, and there's been a packed news day. So let's go ahead and get started. First up, we need to talk about where the markets are sitting. Currently, in the middle of the day, we're at noon right now, or it's noon Eastern Standard Time. We have the NASDAQ up 0.8%, $25,724 on the NASDAQ Composite 100, and the S&P 500, 7,487, up 0.4%. Pretty good day. As it comes to the Mag 7 names, we have Google leading the charge, and we'll talk about this later on, but they're developing potentially new chips under the sort of TPU family that could potentially be 6 to 10 times more efficient than their previous chips that they've ended up putting out. We'll talk a little bit more about that, but we also have Amazon up 1.9%, Nvidia up 1.6%. This is really on the Kimi K3 story. We'll talk about this as well, but there is no lack of overall demand for Kimi K3, and they're essentially stopping all new subscriptions. So people are not able to sign up for Kimi K3 at the level that they want, and they said there's only one reason why they're stopping subscriptions, and that's compute power. I think that these reactions to Nvidia, it's a $5 trillion company, so we're not going to see these explosive prices. But whenever you have these sort of changes to the actual narrative, that the whole reason why Nvidia could have been coming down in the first place is because the training costs on Chinese models that are coming out extremely efficiently might be significantly lower than the American models. Maybe to point to the fact that you don't need all of this compute, and that you can train, similar, if not better models for much less price. The truth is, and a lot of people are talking about this, and we can actually listen to a couple of CNBC interviews of this as well, but that Kimi K3 is being distilled off of American models. This is the same thing that happened with DeepSeek, and a lot of people believe that this is what's happening with Kimi K3 as well. And so that Kimi K3 is not necessarily going to get a lot better than Anthropic. It can only get as good as its American counterparts. Now, price to performance is still an absolute thing. In Kimi K3, if you can get, Opus 4.8 level models for Sonnet 5 pricing, well, that's a pretty great deal. That being said, if you're talking about Nvidia chips or something like this that primarily are used for training, maybe this changes things. But overall, what I'm seeing is that the Neoclouds are fully booked out. Kimi K3 is having the exact same problem that Anthropic was having not too long ago, that they're, completely compute constrained. And so what do these companies do? They end up going to the cloud providers. They end up going to the Neoclouds. They end up going to Nvidia directly and saying, we need more chips, not just for training, but for inference as well. Okay. So this is a really big story that's unfolding here. And if you guys know the stream or follow it closely, Nvidia is roughly about 50% of my portfolio, give or take, depending on the price of the stock. Obviously, here at 205, a little bit different than whenever we were at $235 a share, but still, it is honestly largely sold off from where I thought that we would be. Considering that the Kimi K3 story is going to be debunked similarly to almost like a DeepSeek 2.0. This idea that these cheaper models will mean less tokens, it doesn't. And, you're going to be compute constrained for inference. And likely, as the market continues to age in artificial intelligence, larger and larger percentage of spend, probably into the, 2029, 2030s and stuff like this. Right now, I know that OpenAI and Anthropic still have major spending plans for training. I think OpenAI's alone, they plan to spend $185 billion through 2028. So there's going to be no slowdown there for training. But after that, we really haven't seen a roadmap for training. So maybe this is where, you know, the Grok chips or the LPXs of NVIDIA's lineup will really start to do well. That's more focused on inference. Did you ever end up buying Palantir? I forgot. Yes, I ended up buying Palantir. And in fact, I'm getting really interested in Palantir. And right before I went live, I was looking at more Palantir stock. And we can actually jump into that if you guys want, because what I'm trying to figure out, there was a clip from Alex Karp. Let me play this here really quickly because I'm trying to understand this clip. Let's go through and have a listen.
In my business, we have much more demand than we can supply. That's like, and by the way, it may be somewhat, maybe the crazy person that still only cares about free cash flow, but we have more business than we can supply. And we have, look, if you just look at our financials, right, you can see like 2 years out, you can see $15, $18 billion in free cash flow.
So are you frustrated by the stock's performance over the last?
$15 to $18 billion in free cash flow. I'm really trying to wrap my head around this. I've reached out to a bunch of the Palantir people who cover this company every day, and I'm saying, okay, he didn't explicitly say that this is annualized free cash flow, or if he's saying over the next 2 years, we are going to see cumulative returns of 15 to 18 billion. Because he made it seem like it's an obvious stat that, hey, if you just take a look at our financials, you can see us clearly getting to 15 to 18 billion. I'm not seeing that. I'll tell you right now, the whole world is not seeing that. But if that is what he's saying, if he's sort of giving guidance on the company, then we are in a world of excitement. So let's take a look really quickly at Palantir's overall December 2028 revenue estimates is at $16 billion. Okay. Now let's imagine that he meant, hey, we're going from December to 2027 or something like this. I'm giving him the benefit of the doubt and skipping 2026 and looking 2 more years out. So I'm actually looking 2.5 years out. Total revenue is where he's saying free cash flow is going to be. Big difference there. Now,
in my business,
if we end up taking a look at free cash flow estimates from Wall Street, what we end up seeing is that right now, in the last 12 months, we've done $2.6 billion of free cash flow. In the estimates of what Wall Street is seeing, we see $6.4 billion for 2027 and $8.8 billion for 2028. This is the current, I did this today, the current free cash flow estimates. That together would place us at around 15 to 18 billion. There are some people that are talking about this being a 1-year number, and I don't know if I can believe that. You're talking about bringing in free cash flow at the rate that Wall Street is expecting you to bring in revenue by. Now, if I go back here a little bit, he did say that he's planning on growing sales 100% next year, which they don't want to talk about. And we're dealing with fewer people. We're doing it with less people, and we have more free cash flow this year than revenue last year. So there's a potential, as he talked about on CNBC a while ago, that he wants to grow by 100% year over year. Mind you, in previous quarters, we've grown their overall revenue growth from 12% year over year all the way up to 84%. Let me tell you something really quickly. Companies do not do this. This does not happen anywhere else, especially in a SaaS name where this is not just selling hardware, you're selling software and the margins are really high, which, you know, Palantir is also sporting. To say next year, off the back of putting up 85% growth, you want to then put up 100% growth is wild. Now, if we end up looking at Wall Street estimates that also had projected out, you know, $8 billion of free cash flow, they have year over year sales growth growing nowhere at 100%. In fact, they actually said that last quarter was going to be peak revenue. Every quarter after this is actually going to go down 80%, 69%, 62%, 45%, 45%. So is this a matter of Karp's estimates are the realistic numbers and Wall Street has not been able to actually absorb what is truly going to happen. So the difference is, let's say March of 2026 was $1.6 billion. And then we end up actually assuming that what he's saying is true. Plan on growing sales 100% next year. Let's take that number from 1.6 billion and go to March of 2027. We're now no longer looking at $2.4 billion of revenue. What we'd be really looking at is somewhere along the lines of 3.26 billion, which is huge. You're talking $800 million beats. You're talking beating Wall Street's estimates by the revenue that we saw a year ago. Like, if that's true, if that's what actually comes to fruition, then I think that, Wall Street is going to greatly correct these numbers. The stock is going to end up doing much better. And then what you're honestly going to end up seeing is that free cash flow could end up destroying, because if you're talking about beating by like 30%, free cash flows could come in potentially way higher than that, because you could beat on margins and then you could beat on the actual nominal number. If that's what ends up happening, then, we are way mispricing where we think that Palantir should be at. Mind you, this is a diversified business. They're growing revenue in two different segments almost identically, okay? So it's not that they're growing and taking advantage of government contracts and geopolitical conflicts. That's not what's happening. They're also growing in commercial and charging very similar rates. Government is being charged roughly a 73.3% margin, meaning it's only costing roughly 28% to actually make this revenue happen. Like the cost of goods is roughly a quarter of the amount that they charge. On commercial, it's almost identical, 72.7% margin. It's ever so slightly below government, but that could be an individual customer that's bringing that down or bringing it up on the government side. You don't really know. But the fact that they are so similar means that, they're charging agnostically. They are seeing customers come in rule of 40 of 145%. And mind you, if we end up seeing margin improvement and sales grow by over 100% next year, this rule of 40 is only looking to improve. That places us in the, top 5 companies right now in the world, like that are, publicly facing of scale, like S&P 500 companies that are, Micron, SK Hynix, Nvidia, those sort of names. That's a list you want to be on right now whenever it comes to growth and margin. Customer counts are growing both from a government standpoint and commercial in general. And one of the best numbers that Palantir sports is net dollar retention, 150%. Let's imagine that year over year, or even, by next quarter, that this net dollar retention did not hit its max. What happens to the stock if this gets to 155, 160? I don't even want to go any higher than that. 150 alone is already getting to insane numbers. So if this continues to climb up, there's no telling where sales is going to go. Okay. And then obviously we need to track where their remaining performance obligation is going, because this is honestly going to show us where revenue can go next. This is all future business, right? So as this scales and we end up seeing, 4.8 or 5 billion or something even higher than this, like a tick up that we saw from Q3, like September 2025 to December, if we see a similar tick up from March to June, then Palantir is being significantly mispriced to where it should be today. Okay. And mind you, whenever we were buying this company, it was like at 115, 107, these sort of prices. Now I think we're already much higher than that. Palantir 135 today, up 2%. So things are doing very well. There's one other slide that I wanted to show you guys, not only consolidated net revenue. This is also what they talked about. Margins improving. We essentially saw a 10% margin improvement, a little bit more than 10%. 10% margin improvement quarter over quarter. Who knows where that's going to go? And then also their cash pile. Cash pile is doing very, very well. $8 billion in the balance sheet, $0 in debt. We're growing cash by roughly 50%. This could be merger and acquisitions. This could be for buybacks if the Trump administration gives them access to actually do that. There's no telling what Palantir can do with all of this cash. Maybe increase their sales and marketing teams like Alex Karp said, they have fewer and fewer people, expenses are coming down, right? Which is helping with their margins and seeing all that. But honestly, if you want to be able to grow sales by 100% year over year, that gets harder and harder to do with less and less people. So I don't know, man. $183 a share right now is what the analysts are placing this stock at, 38% higher than where we were, year over year. Or sorry, not year over year. Where we are today, we're at $183 versus where we are today, but those are 12-month estimates. So they believe that this price is for the next 12 months. Okay, so 38% year over year. Now, whenever we put this up against other software companies, I'm looking at Palantir here versus Salesforce or Workday or Snowflake, Datadog, ServiceNow, many of the other very popular retail names. What we end up seeing is that Palantir is growing so much faster than any of these names. You're starting to see a slight breakout from Datadog, 32%. That is looking good. And it looks nominal whenever it's down here in the large separation, but that still is a very, very fast growing software company. But put that up against the margins as well. The 85% plus the 53% margins. Now we're really starting to stand out. And you can see that stand out whenever we look at the actual valuation. So Palantir's price to earnings ratio, 148 times. But Datadog here as well, and this can happen from companies that have one-time charges or a single quarter in the last 12 months that it was negative, that their PE ratios can spike up drastically. That's perfectly fine. I'm not going to judge Datadog based on an individual, price to earnings. Plus, that's trailing numbers. Markets are forward-looking. Well, let's look forward-looking. Whenever we take a look at software's forward PE ratios, we see Snowflake at 127 times. I see Datadog at 105 times, and then I see Palantir at 83 times. That is not bad. Now, actually, I got to double check this really quick because I see the June thing here. I just want to make sure that that's fully up to date for you guys, because I just want to make sure that we didn't get the wrong dates and I have to fire somebody. Let me switch over to here. This is Fiscal AI where I actually build these anyway. And then we will look at here. And this is forward P. So once this loads, I'll see the, make sure it's all up to date. So what was the date going back to there? June 2024. June 2024. No, that's up to date. That is up to date. Okay. No firings have to happen. Let's jump back in. So let's quickly talk about valuation then. Palantir, like I just ended up showing off, you have 71 times forward. Well, on this one, it says 75. On this one, it says frickin' 83. Huh? Unless these aren't up to date. Oh, you know what? These ones aren't up to date, and that's my fault. All right. So we'll just focus on this because that was actually whenever the price was down here, the little dip. It was part of our last video. So it's 83 now because the price has gone up, from 118 to 135 or whatever. That's fine. Anyway, you see the 83 times. It's not anywhere near where Salesforce is, 12 times, Workday, or ServiceNow, but it is pretty well priced whenever you put the margin and the growth rates on top of the actual valuation for forward PE. And I'm not even talking about free cash flow right now. If you were to talk about free cash flow based on their $15 to $18 billion, like this company gets extremely cheap. So that's very important to tie into it as well. But yeah, I'm honestly head over heels right now for Palantir. I would buy more anytime that this thing dips down. And the only reason why I'm not looking to sell anything to rush into Palantir here is because the software names are still very tentative. Like the market has not decided where to value these names yet. And you can see this in the stock price. Let's bring this up. we'll look at like the last 3 months of Palantir's price action. And you can see on a company that's only shown off earnings literally during this time. So right here was earnings. And that was way better than expected numbers, higher growth rates, higher retention numbers, higher free cash flow. It was just a beat across the board. Guidance was improving as well. And what you can also see is that the stock has essentially stayed stagnant this entire time. We're at roughly the same price that we were. And there's been moments of, stock price shoots up on no new numbers, $163 a share, all the way down to 106. No new news, potential new contracts, new Zeta partnerships, Golden Dome, some government contracts. They made Maven a platform of record or program of record for the Pentagon. All of these things are good stories, and yet you can still have price action that is extremely volatile on the stock. So what I'm doing is I'm DCAing into this company. I'm buying over time. I'm buying whenever these dips happen. Whenever I see this happen, I'm buying. Whenever I see the spikes up, I'm not selling, but I'm just holding through those moments. And another thing that I want to talk about is covered calls on Palantir. In this market, it's very, very volatile, but that also means that the pricing on those covered calls can be very juicy. And so Palantir, during those spikes up to potentially 160, and as the numbers get better, I'll probably look to do this if it gets closer to about 180, is write out covered calls, potentially a month out. Happy to roll if it continues to blow through my price. But remember, this is an expensive stock. We do have, potentially increasing growth and increasing free cash flow, but there will be moments of this speculation during, as we try to figure out what's happening with artificial intelligence. So I will be doing covered calls on Palantir, not doing them here, probably going to be doing them in another, 30% higher in the stock price or 40% higher in the stock price from here. And then I'd be comfortable to try to make a little bit of money on my position and happy to roll out further and further if the stock price just blows through it. But yeah, a lot different situation than whenever Palantir was $20 a share, because now we're sitting at a 300, and I'm talking about doing it at, roughly 400 or $420 billion worth of market cap. A lot harder to make that company just explode to, 2 trillion like it did back whenever the company was like $40 billion in market cap. Okay. But anyway, that was my Palantir rant. Super bullish on this company. Let me know what you guys are doing with that company, if it's interesting to you at all. I also want to bring on a guest. He'll be coming on in the next couple of minutes, who has also been playing the software space, potentially not Palantir, but we're going to be talking about another stock that he's, chosen to rotate into. I am early. So for the next month, I think we're going to be doing about noon to 4 p.m. streams. Too much crap talk on the fact that I only work 1 hour a day. So you guys won't believe it. I'll be working 4 hours a day. Yeah. All right. Let's see. Just joined. What are your views on Kimi K3? Only risk to Anthropic and OpenAI? Yeah. And Google and Microsoft and any other company that is trying to be a model provider, that aspect is going to be impacted. But Kimi K3 is going to essentially benefit, at least from the looks today. Let's have a look. Kimi K3 just showed this off. Here. Kimi K3 has received far more love than we expected, and our GPUs are feeling it. Over the past 48 hours, demand has pushed close to our limits of our current capacity. To protect the experience of our existing subscribers, we're temporarily pausing new subscriptions and prioritizing compute for current members. Existing subscribed users will not be affected. We're adding capacity as fast as we can, and we'll reopen new subscription spots in batches. Going forward, we'll also split membership into 2 more focused plans: Kimi membership for Kimi web, app, and work, and Kimi code memberships for coding workflows. And this has been screenshotted a bunch. People are literally saying, look, we can't even get access to Kimi K3 anymore. Like the subscriptions are blocked. So what happens there? You know, they said their GPUs, literally, they spelled it out in the first sentence. Our GPUs are experiencing overtime, and we're trying our hardest to get more. This is what's happening to all of these companies. So you're seeing, you know, look at the Neoclouds for NBIS or IREN or, you know, CoreWeave. If Kimi can get access to those types of companies, if there's going to be any of these deals that are, you know, working overseas, then great. If not, then they'll look to potentially get access to Chinese chips or H200s that have now gotten clear access to Chinese markets, a limited amount, but I think that's roughly 200,000 GPUs per customer. I think there's 10 companies that were selected and allowed to purchase Nvidia chips. So it's even the Chinese government, who does not want to allow Nvidia in, is allowing them in because they're realizing this compute constraint is this restrictive. Okay. And whenever people are talking about this AI situation, what they're not just taking into account, they're trying to project out what the future is going to look like rather than just what you're seeing in front of you. What we're seeing is not an individual bottleneck like memory. We're not seeing an individual bottleneck in, you know, permits or something like this. What we're seeing is across the board restrictions and constraints in the entire industry. There's a lack of land. There's a lack of labor. There's a lack of power. There's a lack of well, I already said land and shell and, you know, labor. So, you know, those. There is a lack of GPUs. There's a lack of optics. There's a lack of memory. Like all of the components, the transistors in the tiny components that are just required to set up these chips and servers are lacking. And whenever this happens, you have to realize that this is more than just a simple bottleneck. This is the entire industry just changing the economics for other businesses around it because all the money is flowing into artificial intelligence. So much so that Chamath just actually was talking about this, that this could be a more structural problem for Bitcoin because the old money that used to be marginal energy to mine Bitcoin is now just being reallocated to AI tokens. And that is a very, very interesting take that I hadn't quite thought of before. Why mine Bitcoin? Because proof of work is essentially proof of energy. You're willing to give out your very costly energy, and in return, you end up getting Bitcoin for solving problems. And yeah, but if there is no lack of demand, if there is no such thing as marginal energy, because you could just give it to an AI company that's almost guaranteed to use it, then it's probably way better serving AI tokens than it is mining Bitcoin. I'm curious if you guys think of that way, or if you've thought about that. But that could structurally hurt Bitcoin just a little bit more. But obviously, Ethereum and these sort of companies are different because they're proof of stake. The only requirement to Ethereum is that you have Ethereum to prove the safety of Ethereum, not the actual energy cost. So that would be the difference between proof of work and proof of stake in those two situations. But that was a nice little update there. Let's go ahead and take a look at the markets, and then we have a guest joining us here in the next little bit. Okay, IREN up 18.8%. That's looking very good. This was on the back of some new news that they updated their ARR targets for 2026 to over $4 billion. They have customers including Microsoft, Nvidia, Perplexity, Figure AI, Fluidstack, and many more. So, this news release from them, which was not a Wall Street estimate, this was directly posted on their website, doing $2.8 billion in new customer contracts and seeing a massive increase in their ARR targets. So great sign from IREN, but also a very good sign for the rest of the Neocloud markets. And we'll talk about some of the Wall Street updates. In fact, let me just go through some of them now. NBIS also just did an update. Where is this? Northland raises its price target on NBIS from $248 to $410 and keeps an outperformance rating. So this was actually, they did do this raise. NBIS having announced the company's first secured debt financing deal on deployed GPU infrastructure, which CoreWeave's been doing for some time. Formally demonstrates its non-dilutive business model. So funny that you're now giving the advantage to the non-dilutive business model companies, which the firm sees as answering a key lingering doubt. But the other companies that are raising debt and not always just, diluting more shares is an advantage. But honestly, I would have been perfectly happy with NBIS diluting shareholders whenever we were at like $300+ a share. Like those prices are super high. But I'm going to ask that exact same question to potentially the next guest if he's ready. So, brother.
Hey, what's up?
How are you doing?
Let me fix this. I'm doing well. How are you?
Doing very well. Those bricks look real.
I know. Yeah. I get that a lot.
I was just talking about CoreWeave and NBIS. NBIS, you probably saw, just got a price increase from $248 to $410 from Northland.
Yeah. I mean, not surprised, man. Like, it's just so interesting to see how mercurial this market is from an emotional perspective. Last week, it was like, oh yeah, Kimi's going to do everything way cheaper. We have efficiency unlocked. We're not going to need that much compute. And then over the weekend, I don't know if you saw the news, but like they were like, hey, we're going to pause these new subscriptions because we don't have enough compute. And then did you see what's his face's, the CEO of Databricks, his comment today?
No, I saw the Replit one. I was going to cover that later.
Let me pull this up because like this validates the thesis for NBIS, CoreWeave, and others. So this was the CEO of Databricks. I'll read it out to you guys. We host open source models such as Kimi and offer them to our customer. Demand has been so strong that we are running out of GPUs across multiple regions. We nearly exhausted our GPU capacity in Asia, and demand is rising in countries including Japan, South Korea, and the United States, and India. We therefore need to acquire a number of additional GPUs, which require significant funding. That demand was what triggered our latest fundraising round. As we know, Databricks recently did their, I think, Series M, something like that.
Yeah, I was targeting like 188 billion, right?
Yeah. He continues, we were inundated with customer requests and needed more GPU capacity. GPUs are extremely expensive to acquire. So, like, you read that and you tell me that data centers are going to go to zero because the demand is overblown. Like, it's just not happening, man. Like, the thesis is still intact. The market is just being emotional based on whatever news it sees. And the reality is that all these businesses are going to outperform even further than they already have, and they're going to do very well.
Yeah. It's surprising how the market's been questioning this build out so much, where it's like, okay, what do you think's going to happen whenever the Kimi K3? Yeah, the training cost is really low, but the inference price is still very high. So how is this changing the math for a company like NBIS or CoreWeave or any of these companies that, by the way, are continuing to raise? Meta's looking to raise more capital. Like, everyone worried about the whole excess compute, but no one worried about all the rumors about them raising additional capital. How do both of those things come together? I don't get it.
I think the way that I'm looking at this, at least, Tanner, is I'm looking at the macro thesis that the demand is structurally intact and data centers are going to benefit because they're going to be sold out for years into the future. And the build out is going to be so slow. Like Meta's new data center, they're expected to complete in 2032. Bro, we're in 2026. You know what I'm saying? Like, the market is forward looking, but at the same time, the market in many ways doesn't know what to be emotional about, because it'll sell something off 15% intraday because of some news that's coming 6 years from now. Right.
Yeah.
And what could that potentially mean? The fact of the matter is, like, these names are volatile because there's a lot of execution risk baked in, and you actually need to grow into that premium that the market has given you. And that's why every little piece of news makes it so sensitive for these stocks to go down. Somebody's calling me. Hold on.
Yeah, there is, although there's planned data centers that are coming out like by 2032 and stuff like this, there have been ones from years ago that are coming online now. Like I think Meta has something like 1.8 gigawatts or something like this right now, but they have 5.5 gigawatts coming online at the end of this year. So there is a lot coming online now, but yeah, now the data centers that we're talking about are for way into the future.
Yeah, and whatever's coming online right now is not nearly enough to service all of the demand. And people make this case as like a potential bear case for NBIS or for CoreWeave to say that they're just a stopgap solution for the hyperscalers to eventually displace them. Like your customers are going to become your competitors type of thing. And even if that were the case, which I don't think it is, by the way, but even still, you would need between 5 and 7 years for the hyperscalers to build out all the capacity to even start to meet the demands of themselves, let alone sell excess compute, right? So I think NBIS and CoreWeave, they're going to be around, and IREN as well, who just had big news this morning. Like they're all going to be around for quite a while, and I think they're staples at this point, not necessarily stopgaps.
Yeah, dude. It wasn't just NBIS that got a price upgrade today, $410. CoreWeave also got a price update from B of A today, $140 price target, which was where we were not too long ago, and that price target would have brought the stock down. But today, CoreWeave is sitting at $75 a share. Does this, reinvigorate shareholders to try to, pump this stock up again? Or do you think it's just going to lay flat for a bit?
I don't think anything B of A can potentially say will make CoreWeave pump. I think B of A, along with all these other analysts, will ride the bandwagon of, like news like the Databricks CEO, news like, Kimi pausing subscriptions. Like these are the things that lead to those analyst upgrades, not the other way around.
Yeah.
Right. So look, CoreWeave at 140, does it deserve to be there? I think there's a strong case to be made. I think the market right now is a little bit hesitant because you have earnings coming up and people want to go take some chips off the table for earnings. And so you have a sell-off in high beta names. But after we get through that earnings gate and we validate that the thesis is still intact, we get commentary from these CEOs on what's coming up in the future, then I think that's going to be the catalyst needed to drive all these names up higher. That's what happened last quarter. And my bet is that it's going to happen again this quarter.
Now, would Cathie Wood change your mind on that?
No.
She bought quite a lot of CoreWeave and SpaceX and Meta on Friday.
No, I mean, look, I think I've changed my stance a little bit on this over the past 6 months. The reason why I don't put that much weight on the Cathie Woods of the world, and I'll put Tom Lee in this bucket as well.
Does this include Leopold Aschenbrenner?
No.
Okay.
It doesn't. The reason I don't put enough weight, or the reason I am discounting the Cathie Woods and the Tom Lees of the world, is because they're permabulls, and permabulls often miss out on what the actual news is. They don't evolve their opinion on how the landscape is evolving, and as a result, they become tone deaf on the market. Tom Lee is still coming out and saying, "Oh, BMNR is going to be, $5,000 or whatever," and it's just not realistic because a lot of investors who have held BMNR are down. Most of them, I would say, are down. Right. Same with Cathie Wood. Right. Like her fund has underperformed for the past 5 years, and she's still being a permabull. I agree with what she's buying. Don't get me wrong. I disagree with how she's approaching it. Like I want a more nuanced take. Now, the reason why Leopold doesn't fit in this is because Leopold published a paper in 2024 and he exactly invested in his convictions. And that's something that I definitely respect because he's putting his money where his mouth is.
I saw Chris Patel share this. I don't know if I saved it, but that Cathie Wood back in the day tweeted that it was part of their strategy to lose money so they have to pay, so then they can pay less in taxes.
That's stupid.
That's she deleted the tweet, but she here, let me see if Chris...
That's the stupidest take I've ever heard. It's like, hey...
I know it's stupid.
You know what? You pay zero in taxes if you're fucking broke. So just be broke.
This is a swear-free channel.
Oh, sorry.
As a result, our trading-related capital tax losses should offset trading-related capital tax gains for years. An underappreciated asset associated with our strategies. This tweet was later deleted.
Yeah, well, there you go.
Underappreciated. That's genius. Something Warren Buffett can never understand.
Yeah, exactly.
Dude, what are you thinking about some of the other names in the markets right now? Me and you essentially met over SoFi.
Yes.
SoFi has been a little flat or stagnating because of market decision or rate cut decisions, these sort of things. Where and how are you looking at SoFi right now?
Yeah, look, I think SoFi is a rate story. I mean, I know I posted this with a video and Chris Hager came out and disagreed with me. And like, I'm not saying the fundamental business is rate dependent because we've seen them execute on a high rate environment and especially through a student loan moratorium. So I'm not saying it's a one-sided business that will get disproportionately hurt by rates. I'm saying the way that the market is perceiving the stock currently is a rate story. SoFi was at all-time highs when rate expectations were at 2 to 3 cuts for 2026. SoFi hit, it was down 50% when the rate expectations dropped to 0 rate cuts. I think as we go into 2027, my bet is that the market perception is going to move towards 1 or more rate cuts in 27. And as a result, SoFi is going to catch a bid because they also have that execution going for them. And the business is still growing over 40%, right? So I think I'm okay holding SoFi. I've been buying leaps into 2028 for SoFi, and I think they're going to start to pay off, similar to how the leaps that I bought for 2026 paid off when I sold them late last year. So SoFi is boring, I would say, in the grand scheme of all the AI stuff that's going. It's way less exciting from a thesis perspective, but what they're doing as a business with big business banking, SoFi USD, and others, like that's going to pay dividends down the line.
I gotta check the SoFi USD numbers. I haven't checked them in a while. Oh, they're just flat right now.
Yeah,
we're at $304 million of market cap.
Yeah.
There's been a lot of changes, though. I mean, Circle has recently got approved for a bank license. You ended up seeing OpenUSD and USD Global end up really popping off, and Robinhood's using USDG, and some of these other companies are using OpenUSD. Do you think that the offering that SoFi had for SoFi USD is still going to be as strong as what it was? I mean, literally 2 weeks ago.
I don't think it will fluctuate on such a short sort of time frame. I think the macro still holds that there's going to be demand for SoFi USD and just a whole offering of like everything out of the box for these big institutions, that they don't have to set up their own coins, that they can just do it through SoFi. I don't think crypto right now, like AI is a new crypto, from the market sentiment perspective. And until we get crypto turning around, I think the market is not going to reward SoFi for crypto.
Real quick, just because the market ended up seeing a large red candle here. This was Trump. He said, every time Iran kills an American soldier, they will pay for it many times over. He passed this directive off to the Secretary of War, Pete Hegseth, and other military leaders.
So what are they supposed to do? Just sit and get bombed and not do anything?
No, I'm just saying.
Like, what is that? What are we doing here, guys? It's like, we're going to bomb them, but you can't bomb us back because we're going to bomb you harder. It's like, yeah, that's what a war is, man.
Fair enough. You've been buying ServiceNow. This is actually what I really wanted to talk about.
Yeah.
I've been buying Palantir. Saw you pick it in your draft.
Yeah.
But what's going on with ServiceNow? What do I need to understand in this business to get me to buy?
I think, okay, so let me frame. I don't view ServiceNow as like, oh, I would have bought Palantir versus ServiceNow. It's just, I saw ServiceNow as a very oversold thing, and I entered it, and it's still in the swing bucket in my mind because I don't think it deserves to be this oversold. Why is it so oversold? Did something change in the fundamentals? Absolutely not. They're still growing over 20%. Renewal rates are like 97%. everything is, they're actually making like, 1.5 billion from AI, which is higher than their expectations. And, their CEO is raising that guidance again. We're going to see that very shortly here in a couple of days. But essentially, it was really interesting, the perception shift when Jensen stepped on stage in his keynote and described ServiceNow as, the operating system of AI agents, endorsing that partnership with ServiceNow. And it went completely counter to what the market has been selling them off for. The reason ServiceNow has been sold off is under this narrative that AI is going to kill SaaS. And while that might be true that AI will kill some SaaS that doesn't have a moat, ServiceNow is positioning themselves from like a workflow vendor with some AI features to being this entire orchestration and governance layer for AI agents. As we move more towards an agentic use case, this is why I think they're raising their guidance for their AI revenue. That revenue line is going to increase further. The business is trading incredibly. It's trading under a 1 PEG ratio. So like it's still growing over 20%. The number that I'm looking for is the remaining performance obligations, the remaining contract values, essentially. If that's over 21% this quarter, I think we're going to see a re-rating from the market. And I just think that we're at a point right now where this earnings, I think, is going to be very instrumental, Tanner, because it will allow the business perception from the market to change. The fact that, in my opinion, if they actually report good numbers, they validate that they have a moat and that they're going to be around and benefiting from AI. And I think they're going to be seen differently than what SaaS has been. Like SaaS has been sold off in a bucket, right? You have CRM, Adobe, like all of these, just sell, ask questions later. And I just think there's opportunities always in that, and ServiceNow is going to be one of them.
SoFi is also a company under 1 times PEG.
Doesn't deserve to be there either.
Let's see where Salesforce is, like a company like this. Salesforce has a lower PEG than ServiceNow.
Yeah, I mean, but like, what's the thesis with Salesforce? Like, sure, it's very sticky. I mean, I don't know. I haven't looked.
Would it not be the same thesis as ServiceNow? Just execution differences?
I don't think so, because Salesforce is not going to play as big of a role as ServiceNow with regards to governance or orchestration or anything like this. Like with ServiceNow, there is a thesis with regards to AI. With Salesforce, it's like they're going to implement Agentforce and they're going to implement their own sort of AI solutions. And it's embedded into their SaaS offering. And it's a SaaS offering that is very sticky because there's high switching costs. So, I mean, again, this is not like, let me see what Salesforce is at. I'm not nearly as knowledgeable on Salesforce as I am on some of these other names. But if we zoom out, let's say 12 months from now, right? That will be enough time to see which ones are oversold and which ones are actually, going to be disrupted as a business. And so this is just what this is. Now, if ServiceNow comes out and the renewal rate starts to fall, or the remaining performance obligations start to fall, or some of these numbers that say, or the guidance is lowered, then I'll be like, okay, maybe I was wrong about this. Maybe that they are getting disrupted, and I don't want to hold this position. This is why it's a swing for me.
Yeah. Now, what about another name that you put in the draft, Palantir? How do you see that differently?
I mean, look, Palantir has a great growth rate. Nobody can deny that. It's been completely oversold from 200. I think they're going to do very well. It's going to be crazy actually to see if they can maintain this growth rate, because Karp came out and he said, hey, we can do 100% next year, something like that.
Yeah. Which is not maintaining the growth rate. That's extending.
Accelerating.
Yeah.
Which is like, I don't know, man. Like, I'm not bearish on Palantir in the slightest. $320 billion market cap. Like, the thing with Palantir is like, the reason why I haven't been as interested in Palantir is because over the past year, they've done a 10x. And so I think the stock retracing after doing such a big move is kind of normal. And it's growing into that valuation slowly.
Yeah. I didn't like it on the way up, for real. At $100 on the way up, not a fan. But there's been a lot of quarters since then to prove the retention rates, the free cash flow, the growing cash pile, the, expenses have all fallen. I remember whenever me and you were looking at Palantir back whenever we were doing podcasts with Amit, early SoFi Weekly days. A lot of people don't know that. Early SoFi Weekly days, it was Amit, me, Tevis, and a guy named Riley.
Way early. Yeah, that's like 4 years ago, 5 years ago.
Yeah. And Amit was hot on Palantir even back then. But, the expenses during that time, the stock-based compensation back then was like 30% of revenue. Like, it was disgusting. Like, I remember all the metrics didn't look good.
Yeah.
And then I had to just trust.
They didn't have the AI business, right? Like,
they didn't even have AIP.
AIP came much after, and like Palantir was growing. Like, when I sold off Palantir, it was like the worst quarter, and they grew like 13 or 14%. And
or 12.7% or whatever it was.
And they had fallen from 30% growth down to like 13%. And then AI came and it completely reinvigorated their business, where every single quarter their growth rate has been increasing and increasing. But like, look, I think, okay, fundamentally, super bullish on the business, have nothing bad to say about it. I think it's tremendous what the management team has done, and the niche, let's say the TAM, the business has carved out for itself. Market perception wise, the last 4 quarters, Tanner, that they reported, the actual numbers were fantastic. The stock sold off on them.
I mean, but then you've got to sell your SoFi stock and all of these things if you want to, talk about what stock price does versus the numbers.
Absolutely. But SoFi hasn't done a 10x is what I'm saying. This is why I'm saying, like, it's still a valuation question in my mind. Again, like, if I bought, gun to my head, if I bought Palantir tomorrow, would I be really sad about it? Probably not. Right. But the thing is, I'm just trying to justify why the market could have been seeing this the way it is. I'm not saying I agree with it.
This is what happened with me. I ignored Palantir for so long. It did that 10x, missed all of it. But I felt good getting in at the low 100s whenever the price was at 200 or whatever.
Mm-hmm.
Now that I've purchased it, it's like, I can't even express. It's like whenever you sell off the companies that are like down 80% in your portfolio, you have many more of those than me. And you had to laugh, bro. I'm not actually throwing that kind of shade. That was a joke.
All right.
But whenever you sell off those companies, you're like, all right, I finally just cut my losses, and I'm going to focus on the companies that I actually have true conviction for.
Yeah.
That's a great feeling. And buying Palantir for me, the second I bought it, zero buyer's regret. I want to keep DCAing in. Because if he's right, if the free cash flow and the growing cash pile and all of these things and all of the new products that they've been able to build and deploy, who's to say what comes next? It's the same thing with Shopify or any of these other platform-like businesses that are being built. It's like, you don't even know what their next largest product is going to be, because we've seen it happen over and over with Apollo and AIP and all of these things, that it's hard to judge what the TAM is. What you're really betting on is the founders and the culture of the business.
So why weren't you buying it at 200 then, if that was the case?
Because the valuation was stinky.
So what's the maximum price that you'd be buying Palantir?
Like, I don't know. We're getting pretty close to it in terms of like what I want to add to it, because of the CoreWeaves and the NBISs in the world, and there's a lot of other great buys. Right. Gun to my head, I have to hold cash or Palantir. I'm probably buying all the way to 180.
Yeah, that's fair.
But
the thing is, like, I keep coming back, and I mentioned this the other day on like I chatted with Wolf Financial, and he asked me a similar question, and I mentioned this, like that Buffett quote on, you don't have called strikes in stocks as you do in baseball. Like, you can get pitches all day long around stocks, and you don't have to take a swing at any of them if you don't want to. And there's way more stocks in the market, than the select like 7 or 10 that are talked about on X. And so that's the thing that's never made me really FOMO with Palantir, because it's like, oh wow, I missed a 10x with Palantir. Like, that makes me, obviously I don't want to miss it, but like, it also makes me excited because I saw that company before at 10x. I was investing in that company before at 10x, and I'm like, oh, like this is possible. You know, I can get, and like Rocket Lab, another one, and so on and so forth. Robinhood, like we've seen in the last 4 years, so many companies go on these parabolic runs that it makes me excited to be in the market and to actually make content about investing, because I stay sharp around what are the new companies, right? And it's just like, okay, well, you know, my first buy of NBIS was like $50, right? My average is like 80, but my first buy was in the 50s before the Microsoft contract. And that was even like late because Manuel caught it at like 25. And so I'm like, oh, well, that did a 4x or a 5x, whatever you want to call it. And that's in the course of 6 months. So these are the things that make me really excited, because every day there's another company that's starting its parabolic run. And I don't know, for me, it's like Palantir or cash. It really depends on what the context of the market is, right?
I agree. I think that there's only just of these few generational businesses, the Microsofts, the Metas, the Googles, and I think Palantir has definitely fit into that. Whenever you start to see these things like the Maven, product become a program of record for the Pentagon, it's like, okay, they've realized that no one else can compete, so they're done doing a bid and ask. Like this is the one that we use. I
actually don't like, and I got to go here in 2 minutes because I got a meeting at 1, but I don't think, like, I'll push back on that. There's a few generational businesses, because the fact of the matter is that generations change all the time. AI wasn't a thing 10 years ago, right? Yep. And the generational businesses of 10 years might not be the generational businesses of today. And yes, there are, like, capitalism has a built-in feature where compounding makes the previous beneficiaries also benefit today. But my point that I'm trying to make is that every day, every year in the market, you'll have new up-and-coming companies that will take advantage of some paradigm shift, right?
Like IREN?
Like IREN, absolutely. Absolutely, man. And like all data center players, and like memory, the Bloom Energies, the T1 Energy, like all of these companies will pop out and they'll start to catch a bid, even though they were completely left for dead in the past, or they were kind of stagnant. And that's because the landscape changes. And so I don't believe in this fixed idea of there's generational companies, and as a result, they're always going to be the winners. Yeah, to a certain degree, but the market is so much more broad than that. Anyways, I got to go. That's my final bit. Enjoy the other 3 hours of your show. I actually have a day job, unfortunately. And I'll see you guys later. Thank you.
Thanks, brother. Enjoy your shift at OpenAI.
Thanks.
Okay. That was the great and powerful Tevis. I saw someone say, don't be rude to your guest. Dude, Tevis is not a guest to me. He's an absolute friend. I was talking to him over the weekend, So if you can't be mean to your friends, I don't know who you can be mean to. The guy's got my love. Okay. Hello. The new people in chat. So essentially, this is going to be the new schedule. I'm going live from noon to 4. I want to cover more of the markets. Now, they call me Water Manson. They call me Small Bladder Tanner. They call me all of these things. So we'll need to step away from time to time just so I can make sure that I've got, my facilities in order. But that'll probably be a little halftime. Maybe I can throw on some CNBC or something like that as a halftime show. But for the most part, I've got some different things that I wanted to talk about throughout the day that should be a lot more fun than the regular only 1 hour streams, which would be, essentially wrapping up already, considering we're starting from noon to 4 now. All right. Next, let's go back, take a look at some of these stocks, specifically in the AI space. We have Lumentum back up 7.3% to $786. SanDisk is up to 5.6%. And Micron also up around 4.8%. This got a major upgrade today. Micron did. UBS said that Micron might be responsible for purchasing more than 40% of its shares back by the end of 2028. That UBS expects Micron to generate over $40 billion in free cash flow through 2028, and that once its buyback restrictions expire on December 9th, that the company could potentially use that cash to repurchase more than obviously 40% at the current price that it's at today. So if you know that that's a likelihood of happening today, you're going to buy this stock today for the eventual 18-month or 24-month holding period that you'd have to do to potentially see the stock price go up if Micron's not only going to increase sales, but also purchase a lot of those shares back. I don't hate IREN. I think that IREN today did exactly what we all needed it to do, which was, show customer contracts and people actually signing up with them. And that means that if they have all of this power and compute and everything like this, and they also are signing customers, that could, prove that they could go even much, much higher than where we are today. All right. Lumentum and Coherent. I love to see these optics names going up on the stock draft. I actually put Lumentum in that draft. I still think we're red on this name by roughly 7.5% in the draft. And honestly, Matt is starting to break away with it now. I used to be very close with Matt in this draft, and now he is just taking off. Take a look at this. So this is how the draft has gone, and me and Matt have kind of stayed together for the most part, me being orange, him being, he's in the yellow line. But now I'm falling behind some of his little breakout here, which he's actually shorting SpaceX in the draft, which is just winning him, obviously very, very huge, up 33%, VG up 30%. If it wasn't for ASTS or Micron, he would be doing extremely, extremely well. I'm not doing as well or as worse, in kind of like a little middle ground here. Micron was up 27% earlier. Now it's only up 12. So that's also made me fall a little bit behind. And then SMCI and QXO also a little bit worrisome right now. Did that SMCI probe ever amount to anything? Do you guys know that? Adult diaper sales are bigger than baby diaper sales. I saw that that was about a year ago, I think. But yeah, that did happen. Donald Trump said Benjamin Netanyahu will not be arrested in any way, shape, or form while in the United States of America. He is fighting against the Islamic Republic of Iran, which recently killed 52,000 innocent protesters and has spent the last 47 years killing American soldiers and others. The only ones that should be arrested are the people that led Iran in this unprecedented spiral of death and destruction. Something that should have been dealt with years ago by previous presidents. Donald J. Trump. Sorry, that was a Trump tweet. I don't trust management at SMCI. Neither do I. But I mean, I guess fool me twice, shame on me, and now potentially 3 times. Is CoreWeave crashing? Man, CoreWeave can't catch a break. I don't get it, man. We need some commentary from Dylan Patel. That's what I'm waiting for. I'm very hopeful and would have expected at least by June or July, like, come on, that Dylan Patel, the CEO of SemiAnalysis, would have put out their ClusterMax 3.0 ranking, which they said is coming soon. This is going to reiterate to those businesses and the companies that are looking for more, GPUs, like, who is the best cloud service provider? Who can actually set up the GPUs fast enough, charge cheap rates, have great latency, all of these things. And in the past 2 versions of the ClusterMax ranking, Semi-analysis put CoreWeave as the platinum level with no one else in that tier. They were at the highest level, above and beyond Oracle, NBIS, Microsoft Azure, AWS, Google Cloud, above all of them. I would love to see CoreWeave up there again, but we just have not seen like a third version. All right. They still might be, but it's not been updated. So in the ClusterMax 2.1 ranking, which was sort of their update to the thing, it wasn't actually a real update. They only added new companies. I'm pretty sure it says right here. Let's read. So this was recently. The 2.1 update adds a small set of new providers to the ClusterMax rating system. This is not a full retest of all providers. ClusterMax 3.0 testing is underway with a deadline of August 1st. Okay, that's the first time I've read that. The deadline of August 1st. Focusing on the latest hardware, the B300s with 800 gigabit per second networking. In this update, and by the way, with 800 gigabit networking, that's soon going to be 1.6 terabits, which would be under Lumentum's new networking and stuff as they upscale and scale out to new GPU to new data centers. Pretty cool. But this was their latest update. Let me switch to this. They added a bunch of new names, and honestly, they need to add even more. You have companies that have been doing very well on Twitter, like, well, on the, in their stock, but recently has been posted about on Twitter, like Boost Run here, SK Telecom, Sunrun Cloud, Run Sun Cloud, Alibaba Cloud, Nscale, Humane, Sharon AI, IREN, White Fiber. There's a lot of really interesting names that if you guys have been in this space for a little bit, have almost definitely heard of. But it's a pyramid. And at the very top, among any of the other ones on the April update, it's just not even the April update because they didn't do a retesting. They're doing a retesting now. I guess that's going to be out in 10 days or should be out roughly in 10 days. Thank gosh, I didn't even realize that. CoreWeave, we're looking to be at a number one spot. And if, this is what I'm hopeful for, is that NBIS also shares that number one spot with them. That it's CoreWeave and NBIS and the rest are underneath. We'll see. That would be a lot of fun. Okay. Let's see here. IREN's still doing well. What's not doing well? Air Test Systems down 4.7%. SpaceX down to 122. It hit 120 today. Wow. 52-week low for them. And ASML. Dude, this market's so wild. Essentially, there's been 3 companies that have done earnings so far that are like really ingrained in the AI space. Now, this morning we ended up seeing like Domino's Pizza and AMC and stuff like this. And we are in the midst of earnings season, but we haven't really seen any other AI names that have stuck out until later this week. We'll have Google, ServiceNow, Tesla, IBM, Intel, SAP. There's going to be a lot of great names. But to the the names that are in the AI space that we can comfortably look at and say, how are you doing or how have you done so far? We've had TSM, ASML, and Air Test Systems. All of these companies smoked their earnings, like did so well, blew through expectations. That I'm just really surprised by, that the market has not given these companies favors. Let's take a look at this really quick. So if we open up Air Test Systems, and here you can see the earnings reports, this is the most recent quarter. They were expected to do 18.7 billion. They did 18.8. Sorry, million, not billion. 18.7, 18.8 was actually what ended up coming in at. EPS was expected at -2 cents. They actually did 11 cents of EPS. Huge beat. But the most impressive beat was actually in guidance, where next year's guidance, Wall Street had them put at $85 million. Excuse me. Air Test Systems came out and said, we're actually looking to do roughly about 140 million. They said 130 to 150. So the increase of that 85 million to 140 million is absolutely huge. Essentially, let me just quickly do the math on that. 64% beat. A 64% beat. No one cares. TSMC and ASML, exact same things. Dominated in their numbers, beat and raised, essentially triple beats across the board, higher margins, in like faster growth rates. No one cares. Everyone's looking at these companies as if the build out is essentially still questionable. I don't think it is. But anyway. Let's see CNBC really quickly. I'm pretty sure Gavin Baker was on earlier. I wanted to watch that. Let's have a listen to this. Gavin Baker was on Squawk on the Street. And okay, let me know if you guys hear this and if you want me to increase the volume.
Welcome back to Squawk on the Street. You might remember our next guest from SpaceX IPO Day indicating he would hold his position for the long term. Stock is off more than 40% from the highs, trading below the IPO price ahead of Thursday's Starship launch reattempt. It's made some bold calls on China AI competition and the direction of the market overall. Joining us here at Post 9, early SpaceX investor and Atreides Management managing partner and CIO, Gavin Baker is back. Welcome back. Gee, welcome.
Thank you for having me.
I'm thinking of that day, the SpaceX IPO day, and then a nice shot up to 220. How are you thinking about this drawdown? Is it sort of how IPOs go in the early days?
I think it is how IPOs go. I mean, the simple answer is I'm not really thinking about it. Just we'll see where we are in a year, 2 years, 3 years.
Yep.
My friend Will Dunoff once came on CNBC and he said, he was on the show Fast Money, and he said he tried to be slow money. Think long term. And I think there's a lot of wisdom in that.
Yes. There is still a process, though, to witness the street getting familiar with the story, getting its arms around the possibility. And now we're starting to see some pretty thick reports, analyst reports. And I mean, I think every underwriter has a buy on the stock.
I will admit I do not know what the Wall Street ratings are,
Yeah.
But that doesn't surprise me. And I think the big variable that maybe markets are missing with respect to SpaceX is they monetize a gigawatt of installed power at a meaningful premium to anyone else. They bring on those gigawatts of power faster and cheaper than anyone else, so they make the most profit per gig. And let's just say they bring on 3 gigs next year at their kind of announced monetization rates. That's $150 billion of revenue that's not in the model. And bringing on gigawatts of power, it's really hard. They've proven they're good at it. We'll see what they can do. But I looked at the consensus, it was 73 billion. And that embeds very little for incremental terrestrial gigawatts that they bring on and monetize.
People are a little bit concerned, I guess, about the delay in the launch, right, of Starship. I mean, part of the bull thesis here is that they are able to do this much more frequently at lower costs. So any hiccup in that causes some concern.
Starship is a really hard engineering problem. And, I think they've made incremental progress each launch. But if you're a long-term investor, it doesn't really matter whether we get to reusability for Starship in 3 months, 6 months, 9 months, 12 months. And I would focus, respectfully, people more on terrestrial compute in the next 2 to 3 years, how quickly they can bring that on and energize those GPUs and rent them out.
You mean what they're doing with Anthropic, for instance?
Absolutely. I think you're likely to see a lot more of that.
there are questions about the sort of value of that as the technology changes very quickly, and as these new models come out and leapfrog the old models, and especially if they're coming from China where they're open source and they're a lot cheaper, about the entire economics of the system.
You know, I mean, I guess there are questions.
Yeah.
I don't.
You
I
don't have those. No, why?
really
Why?
have
What's your thesis
Well,
here?
so open source models fundamentally just shift margin percentage and margin dollars from the kind of model layer to the infrastructure layer. If you have cheaper tokens of an equivalent intelligence, we're going to consume more of those. And if you believe, like I do, that we are structurally short compute, then you don't worry so much about margins at the model layer.
And then that's why that feeds you to a bullish thesis on Neoclouds and other elements of the actual infrastructure build. Yes?
I mean, I don't know if I would use the word bullish, but I do think it leads you to an interesting risk reward. Neoclouds, Cerebras, Nvidia, providers of compute, whether it be to frontier models or open source models.
But talk a little bit more about, you know, teasing out what you were just saying about, so we get these Chinese open source models like the Kimi one, and everyone freaks out that they're better and they're cheaper and they're open source. You don't necessarily think it's bad for OpenAI and Anthropic. Why?
Well, it may end up being bad for them, but I just think the fundamental principle, I think open source software like Red Hat, you know, back in the day, now part of IBM, that is much cheaper than software. It's free. But a token, AI, when you consume it, it costs the same amount of compute, of watts, of energy, of CapEx, of OpEx to generate an open source token as it does to generate an Anthropic token.
So then why do corporates have to pay so much more for Anthropic?
Well, because it turns out that there is and this has been very surprising to me over the last year, that there is an enormous return to being at the frontier of intelligence. And I think the future is likely to be one in which maybe a majority of economic returns continue to accrue to these frontier tokens, but the majority of tokens processed are these very cheap open source tokens. And you can think of it, you use, you know, if, you know, every enterprise, they're going to have a symphony of AI models that they use. And you're going to have the, you know, the conductor, maybe that's Anthropic, maybe that's Grok. And then you're going to have a lot of, you know, people playing instruments. And those are these cheaper Chinese open source models that maybe have been fine-tuned on an enterprise's own data. They're worried about their data leaking to a closed source frontier model provider. And I think that is a likely future.
Where the US frontier models remain sort of in charge when it comes to the corporate customers.
I think so. And there is also a lot of, Eric Vistria, partner at Benchmark, posted something maybe 18 months ago that I thought was fascinating. Just there may be as much lock-in at the product layer, at the harness layer, as there is at the model layer. And the products that Anthropic and some of the other frontier model companies have created, Cloud Code, Grok Build, around their models are, I think, an increasing source of competitive advantage and switching cost.
So I'm just trying to think ahead. Like, will a corporate have a lot of vendor diversity in this symphony that you described? Can it be one player delivering a suite?
I think it is highly likely to be a multiple model future. And maybe some of these frontier models over time incorporate the ability, they make it really easy if you're Claude or you're Grok to bring in a cheap open source model that, you know, maybe is a violinist.
Right.
And the conductor orchestrates.
Huh. I mean, it sounds, I mean, I'm just trying to figure out whether companies will want to minimize complexity, minimize vendor diversity, keep, you know.
Well, I think they'll want to minimize complexity, but they will also want the most intelligence per dollar.
Yeah.
One thing that's really unique about AI, for the first time in my kind of history as a tech investor, being the low-cost producer matters. Intelligence per dollar is what matters, and that is a function of what is your cost per token, and having the most efficient infrastructure is really going to matter. And then how much intelligence do you have per token? So to get to an equivalent answer, Kimi K3, which is a great model and an achievement for China, it needs 2 to 3x more tokens. And each token costs compute, watts, energy, CapEx, all of that. And so if you need to produce 2 to 3x more tokens, Well, and so token efficiency, cost per token, I think are gonna
Matters. Yeah.
Yeah.
As long as American corporates are able to buy, I guess, to subscribe for. There's all sorts of regulatory questions there with China.
Well, I do think you will see. We do have a really great American open source company, and it's called Nvidia.
Yeah.
Their Neoclouds model is actually really good, and I think that they are probably throttling it to a degree. They don't want to scare and upset their customers, but I think they could very quickly bring an American open source model close to the frontier whenever they want.
Really? Do you have a position in Nvidia?
I do.
Just for and
Yes.
you do not in Anthropic and OpenAI.
I do not. I was a SpaceX investor, and there's been a detente lately between
We've noticed.
Anthropic and SpaceX, but that came too late for me.
Well, I'm curious where you see Grok actually competing relative to the two of them.
I think that the market reacted in exactly the wrong way to Kimi K3. It's wildly bullish for all of compute, wildly bullish for the AI and for trade. But I think it did really underreact to Grok 4.5 and Muse 1.1 from Meta. Grok 4.5 is on what is called the Pareto frontier, which just measures intelligence per dollar. And on some metrics, it's kind of outside the Pareto frontier. So you cannot get at its level of intelligence, cheaper intelligence. And
So it's not as intelligent as the Anthropic or OpenAI models, but it is more cost effective.
it is more intelligence per dollar.
Yeah.
Someone was reminding me that speaking of the SpaceX shares, that
Just before he ends up switching the topic, I think that's an extremely important point. The Kimi K3 models in all of this, the Grok 4.5s, the MetaMuse Spark, like the 1.1 upgrades, these are all bullish compute. And I think these questions that has really been raised by the market, by Alex Karp, by Satya Nadella, by Chamath Palihapitiya, and all of these market commentators, is whether or not the models are a commodity or whether they are creating moats for themselves. And to me, unless you're betting directly on those companies, it doesn't matter. I think the important part is, are we still going to need compute for training costs increasing to increase the intelligence of the models? I think the answer for most people is that the answer is yes, and that the Chinese models are trying to distill American models so they can only get smarter if the spend is happening from US companies. Still, US companies are buying Nvidia, AMD, Broadcom, you name it. So there's still spend. That spend still needs space on the ground, or in space for data centers, for chips, for the networking costs, for all of that, which Broadcom plays in, which Nvidia plays in, which all of these companies play in and have massive businesses there, huge business. So I'm very bullish there as well. That's really where I'm focused on. The two main areas, and one of them is a subcategory of it, is I'm betting on the semi companies, the actual companies that are developing the silicon that is helping run these models, and inference, meaning like now that we have the models to a certain level of intelligence, they still need to be ran. Like the neurons still need to fire for the brain to, like, the memory is full, it knows what to do. Now you're just telling it what tasks to do. You still need GPUs for that. So as we use these models more and more, Kimi K3 fully booked out, Microsoft and all of these orchestration platforms, whether that's Perplexity or some of these other ones, still need chips to run whatever model that you're wanting to run, whether it's run locally, okay, which a lot of people have been talking about. People are talking about setting up Mac Studios and Mac Minis and all of these things. That's great for Apple. I'm not doubting that there's not a market for that. But if you're talking about a Fortune 500 company setting up local data centers, they're not doing it with Mac Minis. They are doing it with, why run a Mac Mini at everyone's office whenever you can run one part of the building in a secured clean room and say, this is the local compute for our entire organization, which many of these companies, Jane Street and, many healthcare companies like Eli Lilly and all of these things are setting up local data centers. They work directly with companies like Nvidia in order to do that. So Broadcom and Nvidia and AMD will find great mega organizations or governments in which they'll set up local data centers for those companies themselves. That's still sales. And in fact, probably really good margins on that as well. On the other hand, then you have the data centers. And that breaks out into really two subcategories, as I talked about. You have one, the data centers that require data center revenue in order to grow, which is more of a focused play. So you're talking about the IRENs, the NBISs, and the CoreWeaves, where a lot of these companies have rotated their business from a lower margin crypto mining business to really going after artificial intelligence, because the margins are huge and the bottlenecks are, years or potentially even a decade long. Who knows? Who knows how long this is going to be? It's all up to speculation at this point. But they require the money from the data centers, or prepayment, or raising capital, or diluting shareholders in order to raise that capital to set up the data centers. On the other side, the big major cloud businesses, Microsoft, Google, and by far the biggest, Amazon Web Services, have separate businesses that are funding that growth. And by the way, even they are looking to raise capital, cutting dividends, cutting buybacks in order to fund more of that growth, specifically looking at Google in that example. Meta might quickly end up coming out in that space and becoming another one of those large companies, having signed a deal with Anthropic just last Friday, I think, or last Thursday. It came out to say that, there's rumors that it's roughly a $10 billion deal with Meta and Anthropic, that they are setting up to sell, quote unquote, excess compute. Exactly what SpaceX did with Anthropic, Google, and Reflection AI. If there is chips on this earth that are not being utilized, there are companies that are knocking on those doors saying, hey, what is it going to cost us to allow us to use those data centers the way that we want to use them? Okay. Especially if they are of a specific name, like Nvidia or AMD, that, the quality of those chips and the performance is, very well known, and that they can actually put a team or utilize a team of Nvidia engineers to say, hey, how can we end up working this to work for Anthropic rather than just Meta Compute or something like this? Those businesses are extremely well positioned because of those additional businesses. But you also have to factor in that those companies, the cloud companies, need to pick whether or not they're going to use the compute for themselves or if they're going to sell it externally, right? So does Meta want to be a model company, or do they want to be a cloud company? Either way, both of those businesses are brand new to them, brand new to Google, brand new to Amazon, brand new to Microsoft, which Microsoft wants to bring frontier models in the market by 2027. They also are creating their own custom silicon. They also have a ton of land power and shell to build their own data centers. This is a beautiful position right now for me, knowing that even in the face of Chinese models and open source models, that there's a ton of demand, like Gavin Baker just said. And I saw some people not knowing who the guest was. Gavin Baker is the CEO of, I always forget how to say it, Atreides Capital. And they've got a ton of assets under management and have done a lot of mix of both private companies and public companies, very similar to the Brad Gerstners of the world, or Chamaths, or these sort of venture capital / tech investors that also play in public markets as well, hedge funds. Let's go ahead and continue to listen to see what else they have to say about SpaceX, because I'm quite interested in that.
The XAI investment or acquisition came around 105. Do you see that as like a critical level for SpaceX?
No, I think the stock's going to do what it's going to do. I think there's a lot of people who maybe own stock privately and are shorting the stock to hedge that.
Right.
We'll see. And then there's always, for whatever reason, a big kind of New York hedge fund short case in Elon companies. And, there's a graveyard of funds that shut down because they're Tesla short.
Yeah. But a lot of people look at the valuation in this one.
And then that comes down to how many gigawatts of power can they add? And the estimates on the screen might be really wrong. And then what happens? Grok 4.5 is a 1.5 trillion parameter model. They're training a 2 trillion parameter model right now. I think the Cursor acquisition, 60 billion, is looking very smart. That was doing 3 billion in ARR when they bought it. I think it's probably materially higher. So I think there's a lot of variables. They have to execute on a lot of things. We'll see how this 2 trillion model comes out, and after that, they'll probably be a 6 trillion and then maybe a 10 trillion. And we'll see how those training runs go, and we'll see how those models benchmark when they come out. But if they are able to bring on a lot of power and sell that to other AI players at very high rates, and they are also able to bring on enough power where they can also serve their own models at a very low cost, I think that could be very interesting.
It does feel like Wall Street has really put a premium on like the model supremacy over the cost so far.
I think that's a mistake.
Yeah.
Yeah.
Because that's the edge that you think Elon has.
I do think, to the best of my knowledge, he has, Jensen said, the speed in which you bring on a gigawatt is literally cost, because every day that you're constructing a data center, you're employing, and by the way, we should talk about this, like data center builds, they're amazing for blue collar America. You're employing a lot of electricians, a lot of HVAC contractors, a lot of plumbers at like truly unimaginable rates.
Yeah, New York doesn't want them.
Yeah, it's crazy.
Yeah, home builders can't get those guys.
Yeah, exactly. Yes.
Gavin, please come back.
Yeah,
it's good to have you.
Thank you.
It is an important note to be said of how fast Elon has been able to set up a gigawatt of compute through Colossus 2. It was faster than any other company has ever set up a data center. Like, it's mind-blowing. I don't know how they're doing it. Elon's advantage in the hardware space is unlike anything I've ever seen. His ability to throw literally raw materials into one side of a factory and get out full self-driving cars on the other side is something that I think a lot of people are not appreciating. And, well, I mean, there's definitely appreciation. There's a massive cult following for both Tesla and SpaceX, but there are real advantages. You can't look at these companies and say, hey, you know what is the valuation that we're putting on a GM or Ford, and let's apply that to Tesla. Now, does that mean that their current valuations are fully, justified? Maybe not, but there's definitely a premium to what Elon is doing, and that's why his companies are, that's why he's a trillionaire, for real. But by the way, someone said, how does Oracle fit into that? I'd say roughly a mix, but I think they fall more into the Neocloud side, where the actual money from the cloud is funding its own growth. But they do have other businesses, a lot of software sales, but I don't think it's quite at the level of a Microsoft, Meta, Google, Amazon. I'd put them more in the super, super large scale Neocloud side. Okay. What's happening with the Neoclouds? Some of you guys are blowing up the chat. We have IREN up 20%, which, like I said, is justified. If they're raising ARR, that's the best thing you can possibly do. I'm a believer that markets should be focused on fundamentals. If you increase your fundamentals, stock go up. Goldman Sachs just said that we estimate that the newly announced $2.8 billion in contracts represent roughly an additional $1 billion in contracted revenue with an average of 3 years, 3-year term rates. So, wow, we estimate that the newly announced $2.8 billion contracts represent a $1 billion in contracted revenue as well. So this is a huge upgrade from Goldman Sachs, and you're likely to see some green candles here in the next little bit, pushing the stock even higher. That just came out. But yeah, this is why SanDisk and Teradyne and NBIS and all of these companies that have been getting beaten down are seeing nice green days today. CoreWeave, on the other hand, I think is still getting its butt kicked, but we're still up, just not back to $79. Any Neoclouds that I like? I'm a holder of both CoreWeave and NBIS, very heavy in NBIS. I'm also a big holder in Nvidia and, building a position in Broadcom. So really focused on both of those areas. And then obviously Amazon Microsoft, Google, Meta, hold all 4 of those. Okay. Tesla Gigafactories are amazing. Giga, we're looking at getting terafabs soon. For real, you know what's crazy? I heard some estimates for how much terafab is going to cost, and some people have estimated that it might be upwards of like $1 trillion build out. It's roughly 10x bigger than some of their other gigafactory builds. It's looking unbelievably huge. On top of that, you're having the factory build outs and the the self-driving or the self-charging stations all throughout the world. You're having, the Starbase build out continuously and all the rockets and everything like this. The just actual capital cost for both Tesla and SpaceX alone could be a moat in itself, because capital is not something that you can, do from a garage. There's no Steve Jobs ability to just be a smarter coder whenever it comes to just, having a bigger factory. But it is a lot of capital cost. And if you look historically, the best companies, the best performing businesses over time are actually ones that are capital light versus capital intensive. That doesn't necessarily, that's not a foolproof, plan or whatever. Like, you also have the Amazons of the world who have done extremely well while being capital intensive the entire time. But, don't discount the ability for a company like Palantir or Visa or MasterCard or some of these companies that have not needed a lot of capital to do very, very well. And, I think a healthy portfolio is not really focused on one or the other, but a mix of both. Where are they going to get all the water to cool these factories? So this is a common misconception, or at least looking at really, really old data centers and not the new data centers. So NBIS has talked about this a lot, and you're going to see this from a lot of the new data centers from AWS and Microsoft and all of these ones, is that they're closed-looped systems. So the water that you have inside the things is the same water just being ran through constantly. And in fact, it's actually the cooling costs that are more concerning. But NBIS's new Vera Rubin systems, the new architecture, actually requires hot water cooling. Okay. What that means is essentially that the GPUs run at a much, much hotter level where there's less cooling to be done. And it doesn't mean that they heat the water. The water's heated from the GPUs running initially, but you just don't have to bring them all the way down to extremely low levels. They actually run at about 44 degrees Celsius. 44 degrees Celsius is what they cool down to. So closed loop systems, you're looking at golf courses and all of these things. And a lot of people have been talking about the almond industry in California and these sort of things that require, just umpteens more amounts of water than what data centers, gigawatt data centers, are requiring. Large data centers are essentially, this was actually just a stat said by David Sachs, roughly about 2 In-N-Out burgers worth of restaurants runs a, mega data center, but in closed loop systems. Okay. How hot is the factory? Not sure how hot the factory is, but that's how hot the water is. I'm sure the factory runs at a different thing. Not many people inside the factory. Luckily, it's just filled with computers. Data center regulations and permitting red tape is killing U.S. advantages. I completely agree. I've been saying for a long time that I believe that one of the biggest worries about artificial intelligence is potentially, we're having a moratorium right now in the United States, but and Trump has been very clear he's not looking to do anything like this. He has talked down what New York has done, but he has made it clear that obviously states can make their own decisions. And under a different administration, it might be different, that we end up having a nationwide moratorium. And I don't think people are giving enough credit to what that could potentially mean to all of the jobs that work at, Meta or Microsoft or all of these different companies. These companies hire a lot of people. Having American companies that sell compute all over the world is an advantage for the people who work in America. Salaries get increased. The amount of taxes that these corporations pay back, or the people who are making a ton of money, this is because American businesses have thrived. But that also means that you have to export some things from time to time, right? You don't want all these data centers and all the other work and the jobs to be somewhere else, because then you're paying them the price that they want to pay. We want to charge those rates. We don't want to necessarily pay those to other businesses. So yeah. This guy sent me 440 gems. Unk alert. I think that is an unk alert. I have no idea what 440 gems is. You're right. Thank you, Shane. Shane, though. Shane's not that's an unk name. That's an older name. Are there young Shanes? Okay, hear me out. 600 gems. Mike, what is happening? What are these gems? And that's not them writing gems. It literally says that they're giving me gems. Anyway, thank you. I'm sure that, I hope that's monetary. Okay. We're so scared to lose jobs, but ton of us lose trade jobs, lost maintenance, security jobs, etc. Yeah. Guys, I don't get these gems. I'm so sorry. No more gem maxing. Okay, let's see what else is happening on CNBC really quickly. Beta Technologies CEO on customer base commercial launch and global demand. Brett Taylor was back on CNBC. Okay, we have to listen to this. If this is new, if this is from Friday, it said it was posted a couple hours ago. I know he was here on Friday, so let me know if this is old.
Us to talk through everything AI this morning at the table. We're thrilled to have him. Brett Taylor is the co-founder of Sierra and the chairman of OpenAI. And there's so much debate going on right now in your world about open weight models, Chinese models, token maxing, the ROI on all of this, and everything in between. I think the biggest thing that's happened even just the past couple of days is this new Chinese model that's open weight, potentially distilled or maybe stolen. I don't know why we use the word distilled, but from other models. I don't know if it's from yours or from Claude. There's some questions about that. But how do you think about that piece of it? Because literally the debate on X right now among, I think, a lot of your friends is about what this all means.
Well, I like to take it back to first principles, which is why do people choose the model for the task at hand? And I think there's really two topics that I think every time I talk to probably 100 CEOs every single month, so I'm pretty plugged into top of mind. And there's two things, which is AI tokenomics, which is how can I know that I'm getting the value from this spend on tokens? And then I'll use the word sovereignty, which is just making sure, like, what is my competitive moat in the age of AI as well? And I'll say one thing that I think is a little bit overblown about these open weight models is they're not necessarily cheaper to run. Whether or not they're cheaper to train, you don't care.
Because you're using just as many tokens. In fact, they may be less efficient.
Yeah, there's this thing called token efficiency, and it turns out the frontier models are much, much more token efficient. And beyond that,
by the way, just for the audience, because there's some people who are watching who may be like, token what? Why do we call effectively energy expenditure token. Is that a fair
Yeah,
description of what's happening here?
I'll give an overly simplistic view, then I'll tell you why it's wrong. You could think of a token. A token is to intelligence like a watt is to electricity, like a unit of intelligence. And token efficient means how many tokens does it take to complete a task?
To answer the question you've asked.
To answer the question. But they're not every token's actually equal. And if you've used a really advanced model like 5.6 from OpenAI, you'll know actually, wow, the code it writes is a lot better than the previous model. So it's not exactly the right analogy. And that's the thing is actually, I think what we're seeing is for a lot of tasks, it turns out these frontier models from OpenAI and Anthropic are actually just better than these open weight models. And I think it's important for the labs in the United States if you just think about what do you want from a model, you might want it to be fast for some tasks. Let's say you're looking at every credit card transaction. You might want it to be really cheap because this task isn't a frontier task to do. You might actually want the highest level of intelligence. If you're an insurance company and you're doing actuary work, you want it to be great. I think the US labs need, for every price, performance, latency, cost, they need to have the best model available. And actually, I think that's more likely than not, just because it turns out that just having open weights isn't actually the main thing driving any of those costs. And token efficiency, compute efficiency is something that I think the frontier labs are exceptional.
But let's also bring the audience that may not be on board with us into the other piece of the conversation about open weight models. In particular, they're calling it Kimi or K3. This is a model out of China that some people believe is as good as, if not better than, OpenAI's 5.6 or Fable from Anthropic in terms of what it can produce. It may be less efficient, but at the same time, ostensibly should be cheaper. And the other question is how you think they created the model. Some people think the model was effectively stolen. Other people think they actually built it themselves. What do you think?
This is my point, which is, is it cheaper to use is the most important part for anyone considering it. And I don't think I think the jury's out on that.
Right. Cheaper to use for you and I, yes.
Yeah.
But there's also a question of how much it costs them to build it. And the reason why that matters is because frontier model makers in the US are spending extraordinary amounts of money to build massive data centers, in part for us to use the models, but in part for you to build the models. And if you could build the models for a lot less, that's a different game too.
Yeah, I think at the end of the day, it's going to be, how efficient is your inference? And I think the frontier labs are still far ahead here. And I think that's really where the value is going to accrue, because at the end of the day, as you
inference being every time I put in a prompt, I get an answer.
That's right. It's essentially how efficient it is to use these models for a particular price point. And I think this is an area where the frontier labs still have a significant advantage. And you're seeing that from everyday use. I mean, not everyone's used all these models yet, so I don't want to overstate confidence here. But if you're using things like Fable 5.6, K3, 5.6 is still actually, just if you think about what does it take to write this computer program with AI, 5.6 is leading by most of these metrics, and I think that's what the most important thing is.
The other piece of this conversation is we had the CEO of Ramp in here just last week. He actually built a system so you can actually see how much money you're spending at any given moment and whether you're using the right models. Meaning sometimes people are asking the highest end model, what the weather is, which is
like driving a Ferrari to the grocery store,
which is like a terrible efficiency situation. And we've had other people. Dara Khosrowshahi was on the broadcast earlier this week. He's argued that he's not seeing the ROI, the return on investment from all of this. We had Alex Karp, that famous now viral video where he says nobody's getting their money's worth for all of this. And how do you think about that piece of it?
Well, I'll bring it to my day job, Sierra, because I actually think the market's in kind of a quirky spot where everyone's worrying about paying for tokens. And it would be like if you signed up for Gmail and you paid per CPU cycle or something. I believe where the world is going is paying for outcomes. So at Sierra, we make AI agents that help companies drive revenue and drive customer service. But our customers don't pay per token.
Right. And by the way, this is Sierra. Why don't you explain what Sierra does for those who don't know?
Yeah, so at Sierra, we help power things like if you call DirecTV or SiriusXM on the phone, you'll talk to an AI agent now rather than a person. You don't need to wait on hold. We just launched a new product called Horizon, which are long horizon agents that help people originate loans or do pre-authorization for medical procedures and truly drive revenue. But what's really interesting about it is two things. One is you don't pay per token, you pay per outcome. You pay per originated loan or per pre-authorization. And number two is we help you develop a competitive moat in AI because we essentially help you compound the data about your customers. So no matter as frontier intelligence improves, you're actually developing this compounding asset, which is the data you know about your customers and your relationships with your customers. And our thinking is it really addresses these two key issues in AI, which is sovereignty and tokenomics.
Okay, let me ask you a question about your own tokenomics then.
Yeah.
So for every time that you're having to process one of these phone calls, I imagine you, on your end, are having to use an extraordinary amount of tokens. So does the math for you, meaning when you have a successful outcome for your client, your customer, and they pay you per success, are they paying you more? I'm hoping you're going to say yes. I'm hoping they're paying you more than what it cost you to actually produce, but I'm not sure.
Yes, they are.
Okay.
And I would argue it's easier for us as a applied AI company to essentially amortize the R&D cost of developing specialized models for low latency voice conversation than it is for every company in the world to do that individually. And I think the solution to a lot of the problems with AI tokenomics is we don't have a mature applied AI market. So rather than every company licensing tokens and building things from component parts, if we have more companies like Sierra providing these solutions out of the box that can pick up the phone for your toll-free number and you pay for those outcomes, we can bear the burden of managing tokens.
Tell me about.
Let's bring in Neuberger Berman, Private Wealth Manager.
Okay. We'll have another guest on here, probably around 2:30 or so. So that'll be quite nice to end up having a little bit more clarification on the market that we're seeing today. But I'm also getting a story here. Fluidstack, the company building gigawatt scale AI infrastructure for the world's leading labs, just closed an $830 million Series A. Wow, they're doing a Series A? Just closed at $830 million Series A at a $7.5 billion valuation. What is the largest Series A raise ever? That seems huge for a Series A. Am I crazy? The round was actually led by Leopold Eschenbrenner's situational awareness, with participation from Google, Jane Street, and BlackRock. Fluidstack, if you saw from the earlier post about the Cluster Max rankings, they actually rank very, very high on the Cluster Max rankings. This is one of those Neoclouds that is doing extremely well. The company has also led deployment of Anthropic's $50 billion compute build-out, one of the largest AI infrastructure projects in U.S. history. 50 billion compute build-outs, roughly about a gigawatt. Traditional data centers can take 18 to 24 months to deliver. Fluidstack's stated goal is to deploy gigawatts of compute in 6 months. If you just remember from the video that we just watched with Gavin Baker, that time to set up the data center is money, right? Because you want to get these online. Not only are you paying labor costs and all of these things, but it's money because they're not running and making you revenue. So that lack of revenue is essentially a cost as well. If Fluidstack can end up setting up a data center, a gigawatt data center in 6 months, that would be a massive advantage. Now, there's also other things like the difference in setting up the chips. If you guys remember the GB200s to the GB300s, the actual like putting together the components and slotting into the rack for a Blackwell architecture, which is currently where we are, takes about 2, potentially 2.5 hours. Okay. The Vera Rubins is more like click and play. They just snap in, slide in, and it's done. They take about 5 minutes. So all of these types of advantages, not only in cost and speed and performance, but also the setup times for NVIDIA, allows for companies to set up compute much faster. Orders then get recycled much quicker. New orders come in, new customers can end up setting up more data centers. So this makes Neoclouds even better, faster to revenue, but also NVIDIA can see more orders as well. So these types of advantages will compound over time. Michelle, good to see you. So, yeah, you know what? iStarry, you might not be wrong. It might be 6 months with major delays tacked on top. Who knows? Okay. Wow, Tanner is on fire right now. What am I doing differently? The new schedule? Ladies and gentlemen, I'm telling you there's going to be a full overhaul. It took a little bit of training and everything to make sure Marshall was on the team fine. But there's going to be a full overhaul of the streams. We're going to have constant guests, constant segments. I may or may not leak right now that there is a second channel that we're going to be taking all of the clip segments and throwing them onto. That way, for people that don't have the ability to watch 4 to 6 hour streams every day, we'll be posting it on that channel. I'll talk about more of that later on. I won't talk about that right now because we don't have anything uploaded there. And then on top of that, we're going to be doing full deep dives and everything on, Future Investing Pro and all, like, big tick up in the amount of output from my end. Okay. So live all the time. If you guys saw the most recent video on the YouTube channel, that was sort of like an example of what's to come. That was actually taken directly out of the stream. Just some of my commentary on Meta and NBIS uploaded. It worked well. We're going to repeat that a ton. And so Marshall's going to be helping with that. Wow, so he's actually finally working. Good job. Short reels are great. Maybe not shorts. I'm not talking about shorts. I'm talking, like, whenever I say clips, I mean like 10-minute clips, 20-minute clips, shorter than the 4 hours. Okay. Haven't really figured out the whole shorts content yet. Nothing's really working there. But yeah, if any of you guys end up making shorts and they end up doing well, one, you can post that to your own channels and you could just, make the revenue on that yourself off my clips. Or if you get really good at it, I'll hire you to do that for my channel. Because I do need shorts going out, but I'm not doing it. All right. I rarely watch YouTube Reels. Well, I can see the statistics from YouTube actually tells us this stuff. They see all the people who are watching my lives actively, and then they say, what other formats do they watch? And it's very heavy into the shorts. There's a lot of shorts viewers from the regular viewers that watch the streams. So it might work, but it's not something that I can figure out. It's a young man's game. I'm an old man now. All right. Let's check the markets, see if there's any news right now. Judge ordered Paramount to temporarily pause Warner Brothers acquisition in California lawsuit to allow further proceedings. Dude, Netflix got paid out for that. They made their money and literally walked away. And now the Paramount deal is getting delayed. Oh my gosh. Okay. Let's go ahead and take a look back at the stocks. Which ones are working? Also, in my watch list, this is another thing that I wanted to know. There's a big list of stocks here. Okay. These are all the companies that I follow throughout the day. What am I missing? What do you guys see that you're like, oh my God, he never ends up pulling up this stock in terms of the price? Is there a stock that I'm missing? I've got most of the big AI names. Not too many of the smaller cap names. I saw a couple comments about people wanting me to look at their individual biotechs and stuff like this. I'm not super interested in that. ISRG, that's a good one. I do not follow ISRG. That actually is a good one. Thank you. This is already paid out. Lemonade, I should be following. Wolf, I should be following. Yep, following Wolf. JFrog, I don't follow. I don't even care to. Bloom, of course. Credo, I do. Hims, Rock Lab, yeah, I follow all those. Let's see. AMAT, I think I do, right? Applied materials? Wow, I don't. Okay, we got AMAT there. That's another one I definitely should have had. Cypher, I have to, yeah. All right, cool. That just gives me a couple more here. That's really important. ARM, you never talk about NBIS. Good one. AXTI. AXTI, $3.2 billion company. AMC Entertainment, IREN, HUD 8. Is this was this one of the stocks in the stock draft? Did like Chris or Jason pick this? Did Jason pick this? No. Chris. No, I don't think this is a name that Amcor, yeah, of course. LEU, yeah. All those names I follow. Corning, I mean, Nvidia holds it. I have to follow it. Have to follow Corning. Okay, perfect. At least we got a couple extra names. That way we have coverage of everything that you guys want me to. And let me know over time if you don't see something or you notice that it's not being followed whenever we look it up. Just to hit that follow button. Ondas. Wow, I don't even follow Ondas. What the heck am I doing? Okay, that one's a big mistake, and I apologize. I've been, seeing Ondas come up more and more because of Palantir, and I'm doing like more research on that name. Nokia, I might not even have. Oh, I do. All right, forget I said that. Okay. Let's I'm not seeing too much new news right now. AMC had record Q2 results. Is this name back in? Up 25%. Whoa, how did I miss this? All right, we got to look up AMC stock. Highest revenue in 106-year history. Toy Story 5, Super Mario Galaxy, Michael. Oh, that was the Michael Jackson one. That's out? I didn't even know that's out. Oh my gosh. Okay, second quarter results were up 14.2%. Net earnings still posted a loss. 11.4 million compared to 4.7 million year over year. So they're just burning money. Okay. Cash and cash equivalents was $778 million compared to $423 million, up 83.7%. Where are they getting all this cash? Oh my. AMC. Okay, let's listen to that then. Wow, the CEO looks tired, man. He's seen too many movies.
AMC Entertainment shares jumping on better than expected results, including its highest quarterly revenue in the company's 106-year history. Joining us now, Adam Aron, CEO of AMC Entertainment. Adam, welcome. It's good to see you. It's been a while.
Joe, it's great to be on here with you.
The demise, greatly exaggerated. But I think about the Odyssey this weekend and the Odyssey that you've been on since taking over through COVID and through these gut-wrenching just changes in the way the world, the way we view content and how it's delivered. You've had so many things. Yeah, you've had so many things to get through. Talk about this latest quarter, because you have a lot, I guess, to crow about. The best in 106-year history of AMC, in your view?
Yeah, well, look, America's fascinated with the Odyssey this weekend. We announced this morning that we had some 4.3 million guests in our theaters globally to see the Odyssey, and that's pretty much the story AMC's been on. And it led to our second quarter, April, May, and June of this year, where this morning we reported record everything just about. Our EBITDA was $321.4 million, up 70% from last year's 189. And last year's second quarter was a strong quarter. Our EBITDA for the first 6 months of this year is up $228 million. It's more than 2.5 times what it was last year. And as you said, in AMC's 106-year history, both for revenue and adjusted EBITDA, this was our strongest quarter ever.
You had to get through, obviously, COVID, and that was tough, Adam. And in this latest thing, IMAX, it says IMAX ready. It almost seems to me like you can coexist with IMAX. And I don't see that I'm just going to go to IMAX or I'm just going to go to AMC. The entire market gets broadened by the ability to see it on an IMAX screen, or if it's IMAX ready, but that didn't hurt AMC necessarily. It was like additive.
Actually, my friend Rich Gelfond, the CEO of IMAX, would like to hear this. We are IMAX at AMC, and IMAX is us. We're such a large IMAX player. Just right around half of all the IMAX auditoriums in the United States are at AMC theaters.
Right.
So when you think of IMAX, you think of us. And we don't just have IMAX auditoriums. We have.
Okay. I need quick clarification for my own self. What is IMAX? I mean, whenever I'm going to the movies, I pick IMAX. It's a better viewing experience. But what is it? What is an IMAX auditorium? Is it just a bigger screen? I don't actually know the answer to that. Sorry, I'll let you guys answer in the comments, but we'll continue watching. But I just want to make sure. IMAX is 70mm film. Fancy camera. Okay. Everyone's thing is different. Big screen.
About 750 what are called premium large format and extra large format screens. And they were all jumping this weekend thanks to Universal Studios and especially to Christopher Nolan, director extraordinaire.
Your fortunes and the movie industry's fortunes are tied to big hits, obviously. But there was actually an existential question about people who are going to just keep going to movies. I guess that happened during COVID, and there's big screen TVs and streaming and all these other ways to consume what Hollywood puts out. Are you ready to close that chapter out and say we will survive like the song?
Yes, is the simple answer to your question. And it's also true that as a result of COVID, which is 6 years ago now, there was a lot of experimentation. But what Hollywood has learned over the past several years is people love to go to movie theaters. They've been doing it for over a century. And studio after studio is turning out movie after movie designed for the big screen. If you look at the second quarter, we had 6 different film titles, one from Universal, one from A24, one from Lionsgate, 3 from Disney, all of which had huge domestic opening weekends exceeding $75 million or more. And it's happening again with Odyssey this weekend. Right. As you probably heard, it looks like Odyssey is going to open right around $124 million. This is because people love to go to the movie theaters, and Hollywood is responding I think we've won that fight. And if you look at the size of the box office this year, it clearly is going to be the biggest post-pandemic year for both the domestic and global box office.
Adam, I want you to weigh in on two things, if you could. One is, look, if you look at that list, the big pictures are also for the most part, the biggest spenders on these sort of enormous, giant films that need to be seen in the theater, in part because of the extraordinary nature of what's going on the screen. I'm curious what happens to what I think used to be, for lack of a better term, sort of an adult drama, which used to be a big seller at the theaters, and whether you think that is now moved in terms of when you think of the kind of mix of films, that is that moved to streamers, and that the kind of films that work in the theater need to have the sort of extraordinary effects and everything else? Or do you think that changes and returns over time in some other way?
Well, it is a great question.
I don't really care, honestly. It was not a good enough question for me to stay around. Okay. Real Matt Money. The road to 100K. Let's go. Thank you, brother. It's going to be 100K worth of donations soon from Matt. This guy is keeping the channel funded. Thank you, man. I was just going to say, though, I didn't even know half of these movies were out. I don't know if it's like maybe I don't have advertisements on anything, so I don't see the, run-ups or the trailers for a lot of these things. I didn't even know that Michael Jackson movie was out. And supposedly it's done amazing. I wanted to see it. Yeah. But 100K what? He's talking about subscribers. We're at 76K or something like this. All right. Okay. Markets, just looking more broadly, still up 0.56%. Let's take a look at the heat map right now. Good name for semis, which is surprising, right? It was a sort of sell the rumor, buy the news is what it seems like. A little bit opposite. The run up into open source Chinese models overtaking US models killed the semi trade, killed a lot of these AI names. And now that it's actually here and Kimi K3 is showing like unbelievable benchmarks, it's doing fine. Matt Money also said, I hope I meet my wife at Tanner's meetup. Any of the beautiful Canadian girls, Matt, as long as you're not allowed talking to my wife, but because she'll leave with you. But make sure you talk to Matt at the meetup. August 15th. If you guys don't have your tickets, make sure you do so. I did see a lot of signups today, though. I don't know who called it out. Maybe it was Tevis or somebody that's going, but I know Steve's going to be there. Matt's going to be there. Myself, Tevis, all of these people. It's going to be a good time. Hot Canadian ladies. Yeah. I mean, Toronto has the most beautiful women in the world. That's what they say. All right. I wish I could go. You can go. Rocket Lab news. Matt, what's going on, brother? Is there Rocket Lab news we're supposed to know about? I'm working on getting you guys an answer. Rocket Lab. Nothing that I'm seeing right now. It might just be, this could be an individual purchaser, honestly. But yeah, all right. SMCI is coming back a little bit. Nvidia hit 203. That's coming back a little bit, but we were at 207 earlier today. Was that the bottom for the day? Little Trump comment to bring the stock market down. Maybe a little bit of recovery now. Okay, Microsoft 401, staying above $400, just where I like it. Nvidia above 200, also comfort zone for me. Meta still always looking way too cheap. CoreWeave is stressing me out. Stressing me out, but honestly, we just need to see more quarters. Like, I don't think there's going to be any mega deals right now. And honestly, I think the customers that are already signed with CoreWeave are going to be the same ones that end up extending the relationships with CoreWeave. So, you know, I don't know how much they're going to make a big announcement whenever they say, hey, Anthropic actually just wants more compute with us. And they didn't even announce the size of the term last time either. Okay, so you have names like OpenAI and CoreWeave and Meta, which if they just fulfill their backlog alone is going to be so much money. You're looking at like something like what was it? $98 billion of backlog for CoreWeave. So yeah, CoreWeave is going to be fine. Okay, supposedly Databricks CEO was on CNBC talking today about the Kimi AI models. Let's see here. Oh, no, it was from Friday. But they did say that they're running out of GPUs. They did. Let's see. This is only a under 4 minute long video. I just want to see what he has to say.
He's the CEO of Databricks, which is currently fundraising at a $188 billion valuation. And Kate Rooney is probably worth somewhat in the neighborhood of $188 billion as well. Kate, I toss it over to you.
Just below that, Contessa. Well, Ali, it's so good to see you. Perfect day to have you and get your take on all of this. Thanks so much for being here.
My pleasure.
Great to see you. So we do want to start with the funding round, though. This is big news. You guys are firmly one of the most valuable companies in Silicon Valley, $188 billion valuation now. What does it say about where we are, maybe in the AI race? You guys are a little bit different than the Frontier Labs. And where are you going to be spending that new cash?
Yeah, so, we've been seeing acceleration of revenue in every region, Europe, Asia, Americas, and every product line that we have. So, and this has been going on for 6 or 7 quarters, accelerating revenue. So I think that's why the valuation looks the way it does. The question is, why is it accelerating? And, it's across the board. And it's really what's happening is that it's basically, you can think of it like this. Every company on the planet doubled their headcount. They just don't know it yet because they hired all these agents. And the agents are doing stuff. It's not always perfect, but they're starting to use more services. They're starting using more tools. And one of those main tools they use is Databricks behind the scenes. So the agents are asking more questions from Databricks. We're a consumption-based revenue. So then our consumption accelerates thanks to that. So that's kind of big picture what's happening, but that's not why we did the fundraise. The reason we did the fundraise is that this summer we had our big conference, Data and AI Summit. We have 30,000 people that came to it live at Moscone Center. And there we announced something we didn't think was going to be a big deal. We told them that, hey, in our Unity AI Gateway product that we launched, you can control the spend of AI. You can use open source models. You can use proprietary models. We actually give you capacity for OpenAI, Anthropic, Gemini, Grok, and open source models. And this exploded. People want to use this gateway to set budgets, and they want to use open source. And so we're just...
Ali, you're on the ground floor as we're talking about open source. Sorry to interrupt you, but it's such a big headline today with Kimi. I would love to get your take on what you're seeing. You're somebody who is offering access to these Chinese models in some cases. What do you make of the capabilities of Kimi? And how much of a threat is that to the Frontier Labs as we now look at almost $1 trillion valuations?
Well, I mean, look, I think the frontier labs are amazing, and they're going to continue doing great. And but what happened basically is that everybody wants to do cost controls, and they want to control their budgets. Because as one executive of a Fortune 500 told me, his costs of AI are increasing exponentially. His revenue is not increasing exponentially. So if this continues, he will go bankrupt. So he has to do something. So then open source is how they want to, you know, for the really difficult questions, let's ask the frontier American models and pay a lot for it. But for most of these mundane tasks that you're doing, like, hey, take this field out of Salesforce and, you know, summarize it and enter it into Workday, use a cheap open source model. So that's what they want to do. But we're running, so we are hosting these open source models like Kimi. We actually offer it to our customers, and we're running out of GPUs everywhere. We ran out of GPUs, you know, almost in Asia. There's like every country wants these GPUs: Japan, Korea, you know, United States, India. So we just, you know, needed to go get a lot of these, and that requires a lot of funding. So that's actually what triggered this fundraise for us, because, you know, we just were inundated with these requests. We need to get GPUs. GPUs are costly to get. You know, people are expecting that you're going to pay for these. So that's really what triggered the fundraise in the first place. But then, of course, Kimi 3 being released, I think is a game changer.
Yeah, like how many of the queries on Claude Fable 5 do you actually think are giving different answers because it's Claude Fable 5 versus the basic questions that could be answered by extremely cheap open source models? You know, I think that there will be a difference for frontier models, but you're going to need a specific type of question that should be routed to Fable 5 in order to get that type of quality answer that would actually make a difference. This is going to be a big part. Like, that's really what I think the application layer really comes down to, is orchestrating which model and when to use what. And then obviously the managing of agents and all of these things. But right now we're just in the cost phase. Like, how do we just get our cost down? Let alone, you know, how do we manage a subset of like 1,000 different agents that are like monitoring, you know, customer service tickets and all of these different things, like the full workflow. Right now, I just think is your team efficient, or are they unoptimized and just using Fable 5 to say, hey, what should I have for lunch today? Which I bet is still a decent percentage of the questions that are being asked to the most expensive models in the world. Not good. That being said, if I could pivot a little bit, I wanted to talk about this new Archer and Anduril partnership. So Archer, this stock is up 20% today on the back of this Anduril partnership, which I think validates a lot of that company right now. But they unveiled an autonomous attack VTOL that is planned for first flight in 2027. Archer and Anduril introduced Thunder, a runway-independent hybrid electric aircraft designed to operate autonomously alongside crewed attack and assault aircraft. So Anduril actually posted a video on this showing what this might look like. Now, I'm going to keep this video muted just in case that, you know, this is music that potentially we can't listen to or something, but they almost created like a little anime for us because obviously they can't show it in action. This is planned for its first flight in 2027. But essentially, imagine something along the lines of this happening. You don't want that. How do we stop that? Okay, so this would be the armed crews, and then this is the new Thunder, the green drone there. Fully autonomous, but with some extra added Anduril perks. They're going to activate Thunder there. And it's going to be able to deploy drones that not only see where enemy, you know, intelligence or assets could be, but take a look at this. Look how crazy this next step is. And this is all like very futuristic. We'll see if this actually comes to fruition, but Anduril has proven a lot of things that we believe you know, we probably wouldn't have thought was going to be the case a long time ago. So where is it here? Yeah, not only might it fly in the way to self-sacrifice a drone versus a armed versus like a human helicopter, but potentially also deploy other drones that you know, which is exactly what Anduril did with their Anvil drone system, which would be taking out drones with other drones. So who knows? Maybe this is what the future of United States defense looks like. Pretty wild. This part in the video I have not seen. Nope, can't listen to that. Not a chance. All right. Bringing your son into the thing. All right, we're good. Dystopian stuff, or I don't know. Is it dystopian to have an advantage in the battlefield? You mean the future of offense? Well, maybe the future of both. Who knows? Okay. Microsoft plans to test China's Kimi K3 for Copilot as it adds open weight models to Microsoft Azure. They're also talking about deploying their own models as well. By the way, we're going to have our next guest on in the next couple of minutes. So yeah, keep in mind about that. We'll hear a little bit about where this guest believes the market is going in the future. I'll just leak it. It's Chris Patel. It's KP. All right. Hey, Tanner, is Kraken Robotics the play before Anduril's IPO? I've heard this, that they're a big supplier for Anduril, so they're kind of like a proxy for them. I'm not sure. I'm not sure. So our drone will release drones that will take down drones with other drones. Yeah, I think the idea being that the one large drone can do quite long distances. That I think would be the difference. But ladies and gentlemen, please welcome our next guest, the great and powerful Chris Patel.
Great and powerful? Where did that come from?
You've always been great and powerful.
Not really, man. Put me on the other side, so this way it looks more symmetric. There we go.
Because I'm looking this way?
Yeah, and I'm looking that way, yeah.
Yeah, so. There you go. I wanted to ask you about the current state of the markets right now. I just had Tevis on earlier, and he's been buying up ServiceNow. I'm trying to understand this business, and I thought there's no one better to talk to than yourself. Or Bill McDermott, but, you know, I get you for now.
I think I will try to break this down as simply as I can for people that, you know, the reason why they may not get ServiceNow is because they don't work in the industry. Like Tevis works, you know, on the product side of things. So he works probably with ServiceNow. I don't know if he does, but I work with ServiceNow. Like my organization, the hospital system that I have, we have ServiceNow as our default ITSM software. So ITSM is a very cool kind of concept where whenever you're, let's say, working in any organization, you know, I think a lot of people think that, you know, every organization is the same. Like, no, every organization, we have a lot of differences, but then we also have the same challenges. So I work for a healthcare system, right? My healthcare system, we have hundreds of, you know, we're actually thousands of doctors. We've got thousands of nurses. We've got even more people on IT than you could believe. And the reason why is because our job is to serve all of those people. But then every time there's a different application, there's a different thing, we have to kind of manage all of that infrastructure. So we have certain products that are hosted in the cloud, certain products that are on-prem, like we actually have our own data center. Like it's not like a data center, like, you know, like your giant one with racks, but we have our own data center.
Yeah.
And we actually have 2 data centers. We have one that's a data center that's in one of our hospital systems. And then we have another one where we actually contract with a separate company where we host all of our instances. And the reason why is because we need redundancy. When you ever work in a hospital setting, you always need to have redundant systems so that this way, just in case, like, let's say your main data center goes out, you can't just lose all your patient records. Everything has to be backed up. So whenever you're dealing with IT, think of it as you're dealing with this massive organization that has all of these resources, and all of those resources are jointly pooled together, and they have to be managed by people. And guys like me, we manage that, right? So if you tell me, hey, Chris, you know, like, let's say I'll give you some real world scenarios. Let's say right now, you know, you work at a hospital and a software company comes to you and says, listen, I can reduce down the patient wait times in your waiting room. I have this software that does scheduling, that looks at the conditions of the patients, you know, and prioritizes them based on need. And we can actually get way better throughput. But there's this application, and, you know, we can either do it in the cloud or we can host it on your own infrastructure. Just depends on however you want it. And then basically all the doctors that are in the intranet would be like connected to that specific software product. And then you have your scheduling software that could come from, let's say, you know, Epic, which is our EMR system, our medical record system. So they all have to talk to each other. And the thing is, when you work on the application side, all of that stuff has to be managed. Everything has to be controlled. So as an example, when, let's say, you know, we say, okay, we want this product and we want to integrate it. The first thing that we have to do is we have to basically assign where this thing is going to be. Is it going to live in the cloud? Is it going to live on structure that we already have? How is it integrating and all of that stuff? So guys like me, we work on integrating all of that stuff into our system. But then you also have to manage everything. Some users need access. Some users should not have access. There's no reason why someone who works in security needs access to that application. But you do need to have a doctor that has access. You also don't want people that are from the outside to be able to hack into that system, because that opens up a can of worms for HIPAA and everything else. So there's a cybersecurity component that goes into all of that as well. What ServiceNow does is it sort of helps you in managing all of those applications by actually bridging that gap between the people working, you know, to maintain all of those applications, the application itself, and then also the users that are going to be there. So all of those things combined. So let's say right now, you know, you are a new doctor, you need access to the scheduling software. Back in the day, I would have to go into that application. I'd have to create an account for you. I'd have to provision it for you. I'd have to assign a different role for you. Like, this is Dr. Tanner. He needs access to this. He doesn't need access to this hospital, but he needs access to this hospital. He needs, you know, he needs to basically, we need to also make sure that we're auditing everything that you do. Because if, let's say, you know, let's say just do a general user account, just say Dr. And back in the day, that's what people used to do, by the way. It's so stupid, but back in the day, everyone's like, oh, well, the password, the username is doctor and the password is doctor. Everyone can use it, right? It's the easiest way. Like, no one's ever going to lose their password, right? No one's ever going to have to open up a ticket. You come into the hospital, you get doctor, you know, easy, right? The problem is you can't do that. Like, you're opening up a can of worms, because let's say Dr. Tanner is a good guy, but then Dr. Tevis is a bad guy, and he's literally using certain software to, you know, do stuff with patients that may not be good. And then it becomes a big problem. So we have to basically manage all of those things. So what ServiceNow does is sort of allows for end users to interact with us and let us be very efficient at how we do our job. Okay, so as an example, you come in, you say, my name is Dr. Such and Such. You tell me who your supervisor is. You know, your supervisor ultimately defines what your role is going to be, what your limitations are. And so you put in a ticket, you call the help desk and you say, I'm Dr. Tanner. I need access to blah, blah, blah. I verify the information and then I create your account. And once I create your account, you're good to go, right? So back in the day, that's what we used to do. We have to do that individually. And every time you leave, let's say Dr. Tanner says, okay, I'm quitting my job, I'm going somewhere else. I'd have to go into that application and then delete you. Okay. It sucks to do that, but that is what old school ticketing used to be like. You literally have to do this one account, one application at a time.
Right.
Now, the thing is, Dr. Tanner, when you come into this hospital system, believe it or not, you are not using one application. You're probably going to be using 10, maybe 15 applications. Now, how do I fix that for you? Where I'm not creating 15 different accounts. I'm not deleting 15 different accounts every time you come, every time you leave. Well, one of the ways that you can do it is something called AD access, like account directory. And so what I can do is I can create a special group that says all the doctors that work at this hospital, they have access to all of these applications. Right? So every time a doctor comes in and says, hey, I'm Dr. Such and Such and I work for this division, I assign you to that group. You have access to all the applications now.
Yeah.
Right? When you leave, I take you out of the group. You lose all your access to all 15 applications all at one time. Okay. So these are the kinds of IT issues that I deal with regularly. Okay. And where ServiceNow comes in is that you need a system of record to basically allow for the capture of that information, that transaction, and then also all the stuff that happens. Okay.
So
yeah.
Why is this a hard problem to solve and can't be built in-house?
Well, see, let me keep going, because once you see how complicated it is, it'll actually help you understand why ServiceNow is one of those things. Now, if that was the only thing, that's pretty low end, right? You could probably figure things out. That's not that complicated. Where ServiceNow gets even more interesting is, let's say you have an issue, like problem with any sort of application or any sort of like IT. Let's say you need a new laptop, right? Or you're having trouble accessing the hospital systems like network, right? Because you're sitting at home, you're working, and you can't get in. When you put in a ticket, all of that stuff gets recorded, and it's my job to figure out how to fix that for you and get you through that, right? There are other companies that do very similar things. But what ServiceNow does is that it's super, super scaled up. And so large enterprises, they have it figured out, like that workflow layer that's so sticky that it makes everything easy for you. So right now, like everything is provisioned, everything is ready to go for me. They basically, when they come in, they run something called a CMDB, where basically you have all of these applications, all of this information for your entire organization. Everything is loaded up already. It's a very, very complicated process. Think of it as like a giant pyramid where you've got people at the top and people at the bottom, and everyone is interconnected, right? It's not easy to do that at the software layer without being able to scale it up. Okay. And the thing is, like, one of the challenges, if you vibe code something, you could create a ticketing software system. But then what happens is now you have to integrate with all of these other applications. You also have to integrate all of that stuff with all the new hardware. And then when it comes to cybersecurity, if there's a vulnerability that comes, what are you going to do? You're going to vibe code your way out of a software, like a cybersecurity vulnerability. You're going to say, hey, Claude, fix this. Like, no, you need to have a software product that fixes all of that stuff. So think of it this way. Right now, there's people on X, and they demonstrated this. They said, create me a user interface that resembles Apple's, Mac OS. I'm sure you've seen that, right?
Yep.
Tell me, have you said to yourself, let me go and download a vibe coded version and replace my phone with it?
Yeah, no, it's not going to happen.
No. Right? So it's very similar to that in organizations, because we already have we have 10, maybe sometimes 15 years worth of data already on the thing, right? The next thing is we already have all of our integrations built on this thing. All of our applications, everything is already managed on there. The other thing is, from a cost perspective, the cost of trying to vibe code this thing would be 10 times more than just basically paying these guys. Okay. And that's with having a whole army of people maintaining the code on this. It's maintaining a code base is very, very difficult. These guys, they let you do a lot of this stuff out of the box. And anytime there's like new things that come around, they can layer it on top of your existing subscription. So as an example, you have agentic workflows now, right? Like AI is becoming a bigger part of our network and our system. Now, I'll give you a couple of examples of some cool things that I've seen. Let's say right now, back in the day, Dr. Tanner used to come in and he used to put in a ticket, and I used to basically create that account, and I would basically give you access and all that stuff. Do you know what ServiceNow does now? Historically, all of this stuff is already created, and there's past tickets that we've had over the last 10 years. You put in a call to the help desk. The first thing is you hit an agent. You don't even know that you're talking to an agent. The agent says, "Hi, Dr. Tanner, what can I do for you today?" And basically you say, so the agent creates a support ticket. So
even
that's the
internally
first.
They do that.
Huh? Say that again?
Even internally to like other doctors in your system, they will essentially phone up directly to agents.
Yeah. Wow. You can actually, the thing is, like, you don't notice it because you're not, you're basically just Dr. Tanner, and the person on the other line could sound very human like, "Hey, my name is blah, 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 like, how can I help you?" They'll usually tell you they're an AI agent, but they create that ticket for you. Now, that was just the first layer. And that's easy because when you describe your problem, they can basically figure out which team to assign it to. They can say, okay, who your supervisor is by looking your Active Directory up and saying, "Oh, Dr. Tanner's supervisor is Matt Farley. Let me, do this." And so basically that ticket, actually, when you have that conversation, everything gets recorded and then put into that ticket.
Yeah.
But here's the cool part. With AI now, it can go into the system and say, well, every time a doctor from urology, let's say I just gave you urology, calls in and they need access, this is the supervisor, this is the account that they need to provision, this is the group that they need to do. And the agent reaches out to Dr. Farley via email or Slack or whatever and says, "Hey, this person needs access. Should I grant it to him?" Says, "Yes, go ahead." The agent can create your account, and the agent provisions everything, sends you an email, says, "Hey, Dr. Tanner, you now have access to all of these applications. Is everything working?" And when you say, "Yes, everything is working," it closes out the ticket. Zero human interaction.
Yeah.
Now, you tell me how important that is to an organization that has thousands of doctors, thousands of nurses, thousands of techs, thousands of people.
It is. My only things, the only places where I'm questioning you internally is whether or not it's a 10x cost to try to code these things yourself. Now in a hospital,
it would be a 100x cost. 100.
In a hospital, I think that you're like, I don't think these companies are going to go away at all because you need those systems of record, and it's very important. You can't make predictions on
but Tanner,
Tanner, wait. Let me just get to this point. The Starbucks thing that came out recently about them trying to lower their $400 million of software costs from IBM and Oracle and Microsoft.
Mm-hmm.
Does that not worry you that there's other businesses that aren't as important or, as mission critical as a hospital, that Starbucks still pays large fees to all of these software companies that they're trying to potentially get away from?
So I think that was to be honest with you, I think that was a negotiating tactic. Anyone who works in software can tell you that they can try all they want. Mm-hmm. They're more likely to fail. But by threatening something like that, they can get a better deal in terms of negotiating, right? A lot of times
that can impact the ServiceNow as well.
No. It's not the same. When it comes to Starbucks, number one, Starbucks has the resources to actually develop something themselves, right? Like, so that's like the first thing, right? So they do have that. The other thing is a lot of what they're talking about is very low level things that they're paying a high amount of money for. So as an example, like inventory management, like, do you really need to have like paying crazy amounts of money to basically manage inventory? Now, we think this is an easy problem. Just create a freaking dashboard and manage the inventory at all the Starbucks locations on the planet, right? The thing is, like, first, Starbucks has enough money to actually do do some of the work. The challenge that they're going to run into in the future is that every time there's like new updates and they're going to have to manage all of their code bases themselves.
Right.
I guarantee they're probably going to be able to take a very low level thing and maybe make it work. But it really depends on the complexity of the organization. It depends on the complexity of the industry itself and the complexity of the organization's ability to actually do all of the what is it called, the building. I don't know why Starbucks wants to do this. Maybe they really are hitting some level of, hey, we need to just become more profitable and do a lot of this stuff ourselves. Maybe it's a negotiating tactic to get a better deal from some of these other guys. You know, like, I mean, they do spend $400 million a year on software, but they didn't say like which software they want to get rid of and which one they want to keep, right?
Well, they did name, I think, Oracle, Microsoft, and IBM. I think those were the companies in question, or at least in the report from whoever it was.
So let's dive into that. The first thing is like with Microsoft. What Microsoft, first of all, even if let's say these guys vibe coded something, it's probably going to live somewhere. It's going to live in one of the clouds, right?
Yeah.
Like at this point, like no one's like, yeah, let me create my own, you know, like on-prem supercluster that manages every single Starbucks on the entire planet. Like it's just the latency wouldn't work, all that stuff. The other thing is like from a transaction standpoint, like IBM basically owns the mainframe market and they've pretty much got that like on lock. But it's a very low growth kind of thing. Like, and Oracle does have a lot of applications for their ERP, for their enterprise resource management and everything else. But this is one of those things that I think is great in a headline for investors to say, look, we can save $400 million. Ultimately, it's the actual practice that's going to, you know, depend on how they end up going with it. Like, imagine right now, like, you know, me, I'm a CEO of a company and I really want to juice my investors a little bit. I'm going to say, you know what, we can do this ourselves. Now, the thing is, like, our success is not guaranteed. And these guys can end up putting themselves in a really bad place and screw themselves over. And I'm sure that there are certain people in the industry that think that they can vibe code their way out of a lot of these products. But from what I'm seeing, 99% of people, like organizations, they're just like, look, we got something that works. It's good. And especially if you work in a regulated industry, it's much, much harder to leave because a lot of this stuff is based on security that's required, like approvals by different like government organizations that need certain levels of security, certain levels of what is it called? Back testing that needs to be done before you can improve it. So I do think that there are probably going to be some very minor like use cases where people will try to code things themselves and try to create their own infrastructure. But for the vast majority of companies and organizations, especially at the like really large scale, they're not getting off of these things. If anything, AI is probably going to kill the niche software guys and actually propel these guys a little bit, because what's going to happen is you can probably take another software product, vibe code it, like these guys can vibe code it and layer it on to something that's already existing. And now you've got an upsell opportunity. So, I mean,
I agree with you that like just saying that you're going to try to cut costs doesn't mean anything. And it doesn't even mean that you get a better business. Nike tried cutting costs, it killed their business. So, I agree with you there. But let's jump in a little bit more on, I think what people here want to know as well is like, why ServiceNow? What, like, give us some juicy thing that I can title this, like ServiceNow to 200. Like why ServiceNow over a Microsoft?
What's with you on clickbait? Why are you trying to clickbait people? Why are you trying to clickbait?
I'm not clickbait. I want to hear the quotes. What are the, this is a media company now.
I would say if you want to give a really good bull case for ServiceNow,
I want you to do that. I don't want to do it. I want you to do it.
Okay.
I saw you say 90% of your short-term portfolio is now in ServiceNow. Is that correct?
Bro, I have more contracts on ServiceNow than I've shown one of my followers on Twitter, like I probably shouldn't have, but I basically own, I would say 75% of a certain strike.
All right, there's my title. Now you can be
The open interest on that specific strike is pretty much all me. Like,
yeah.
So yeah. I think software in itself is very misunderstood in that people think that it can be vibe coded away. And I think the narrative is wrong. And I've seen this narrative creep up so many times. And when there's like this mass level of hallucination, markets tend to overcorrect. All right. And people just automatically assume that like that industry is gone. And dude, I love it when that happens, because when the market says this industry is kaput, it usually means that great companies get sold off with the ones that are actually going to be impacted. Right. So if you look at like over the last 5 years, look, I'm a multimillionaire now. Like, I really don't need to, like, you guys know, like me and you've actually interacted. You know, like what level of returns that I've had. The times where I've made most of my money is when I've seen these mean reversions happen, where the market considers an industry specifically dead. And it's a very short-term phenomenon. Once that industry figures things out, the strongest players among that industry, they come back, and they come back stronger than ever. So as a good example, like people still give me shit about cruise lines, but cruise lines, when I started buying a lot of my options and spreads, especially on Carnival and stuff, like cruise lines were not exactly very popular. We were just coming out of COVID. People were wondering, people going on cruises again, but I saw opportunity, bet on it hard. Regional banks 2 years ago, everyone said, oh, these companies are left for dead, layered on a lot of options position. Yeah, I layered on a bunch of options on Truist, which is a bank that I work with that I have a small business, relationship with. That's back in the day, it was called SunTrust down here in the South, but it's the largest bank here in the Southern United States. It's not going anywhere.
Yeah.
Do they have some short-term issues? Yeah, but once the regional bank crisis got resolved, all of these guys, they came right back. So whenever you have opportunities like that, you gotta take them, and you gotta go hard on them.
I agree, and I've heard this thesis, but why ServiceNow, and why, like, how do you pick the individual name and not just IGV or something like this?
Well, number one is when it comes to a certain company and you can deeply research it, the recovery is much easier to understand numerically. So whenever you're doing options is one of those things where you kind of have to pick a strike, right? You have to figure out, like, okay, what is the value of a company? I'm not just betting on which direction something is going. Like when you buy IGV, you're basically betting on the direction. You're not betting on a company. You're not betting on a price target. So that's the challenge that you run into. Like if I told you right now, what is IGV worth 5 years from now? I have no clue. Why? Because there's like 100 constituents, right? There's going to be companies in there that are going to 5x, and there's companies that are basically going to go bankrupt. So how would I know what IGV is going to be 5 years from now?
Okay, but you have Salesforce, you've got Palantir, you've got, Snowflake or Datadog. Like there are software names that are coming down. Why service? Is it because of your close relationship with working with it?
Well, the first thing for me is that I understand the product. Like I think that gives me a little bit more alpha than the average person who may just be buying the dip. Like when you actually work with something and you actually understand the fundamentals, it makes a lot more sense, right? Like a lot of the investments that I've made really good money, like United Healthcare. Like United Healthcare a year ago, everyone was saying they're dead, they're done, blah, blah, blah. And I'm like, look, I understand the business here. I work in the healthcare system. I work at a hospital. I know what layers of profitability these guys have and all the levers they have to pull. So when you understand a certain industry, but then when you understand a specific company even more, it gives you a lot more conviction, right? So for me, I work in healthcare, figure that out. Me, for the cruise lines, I've been on multiple cruises. I see how much cash flow they generate, right? TFC, I've had a banking relationship with them. I have family members around the country. Like, everyone laughs at the Patel Motel thing. Trust me, like we work with the banks. We work so you get that experience. I have a cousin who works at Truist. So, he doesn't work he works on the executive side, but basically you could get like your network of people to give you some information. So for me, my network of people expands out. And so like I said, I've had my conversations with people who use ServiceNow, and they're like, yeah, it is what it is. I was at a barbecue the other day for July 4th. I spoke to someone who, works in software sales, right? Software sales. Like, I was like, hey man, what's going on? How's everything? He's like, everything's good, man. I'm like, what do you think of the SaaS apocalypse? He's like, what's SaaS apocalypse?
Yeah.
I'm like,
Yep.
you don't see any? He's like, bro, I don't care. Like, my company's doing more business than ever.
Yeah.
And he works for like a niche software vendor that works for insurance companies. Like, so the thing is, like, a lot of times the market has this irrational way of overdoing things. And if you have even a remote sense of, remote like experience with certain things, you can figure out who the winners and who the losers are. You want to know a company that I'm not very public about, but I think is going to do phenomenal?
Yeah.
Intuit.
Okay.
Intuit is like one of the easiest plays in the market right now. Now, the options on it are not as attractive to me because there's way more attractive risk to reward for ServiceNow.
Yeah.
But Intuit is great. Like, you ask any small business, what are they running on? They're all running on QuickBooks.
I run on QuickBooks.
Yeah. Like, and your Canadian legal system is different. My system here in Georgia is different. A person in Connecticut's legal system is different because you have state laws and regulations. All of this stuff is super regulated. Yes, could you vibe code to it? Probably. But what would be the point?
Yeah. No, I was talking to some a little while ago whenever I was shopping for accountants, and they were just like, across the board, every single one uses QBO. They don't use anything else. Like, you could try shopping around to save a little bit of money, but no one else wants to use it. You want something that everyone knows how to use very well. So yeah, it's a straight moat. But you're not playing that one right now. It's just one that you sort of think is a little oversold.
Let's just say I'm a little too invested in ServiceNow.
Gotcha.
I have ServiceNow, I have Salesforce. So I have my winners. Like, I have some Adobe. So I have my winners already picked out, because what I like to do is, among the companies that have been oversold, I try to find the best ones that I think have the most durability. But then you also have to remember, I do options, right? So the way that I make my money is that I use the short-term move down to basically find the companies that have upside potential and then layer on a ton of leverage, because I do know that the inevitable mean reversion is going to come. Mean reversion is one of the strongest strategies in the market. Now, the part that is really hard about mean reversion is timing the bottom. Like, it's very hard to time like when something could be selling off 15%. You think, oh my God, it's going to V-shape recovery from here, and it goes down another 30. And then you get in and it goes down another 30. It's like, holy shit, I'm down like 50% on my position already. And then
I think Salesforce was down like 60% at some point. I think we're still down like 52% from the highs.
And then when you layer on options, you're basically getting killed by both the stock going down and then the time is coming down as well. So you're kind of losing money on both of those things. So I would not recommend mean reversion, especially for options on companies, for most people. Like, I'd say just stick to just plain old buying the stock. Like, I do options myself, but I don't advocate normal people to do options. There's just a lot of risk that goes into it. And then also there's a certain level of volatility that you have to sit through that can be nerve wracking. Like, it'll drive you up the wall, bro. Like, when stock could be down 20% and your portfolio is down 70. It's like, what do I do here? So
I think ServiceNow, if I'm not, did they miss their numbers last quarter? No, they didn't.
They had a small hiccup in that some of their revenue from the Middle East, because of the war situation, was not going to be recorded in Q1. The deal finalized in like the first layer of Q2. So they're still beating all of their metrics. Like, they're doing extremely well. It's just the market right now, the narrative is anything that's not perfect feeds the bear narrative, right? Like, you go to like Nvidia right now. Nvidia could have amazing, heroic numbers, but if it's not what the market is expecting, the thing will come down. And it's like, it makes no sense. Like, wait a second. Like, no, you're the best.
Same with TSM and ASML. Like, they crushed it, but the whisper number was slightly higher. It's like, dude, these numbers are amazing.
So the challenge that the market always runs into is that the expectation is what drives the stock price to where it is. And the thing is, sometimes the expectations can be very unreal. Like, you know, when we spoke about Micron, and I got a lot of flack from people on Micron, I said, look, Micron has probably some level of correction to go down. And I said, the reason why it was going to go down is because the expectations for Micron had just gotten so massive. And so any sort of indication that maybe, like, you know, they're not going to be as good, or any sort of news that, you know, there's going to be a slowdown in capex or guidance by the hyperscalers, Micron would be disproportionately hit by that, right? So the sentiment could flip on you very easily. And the thing is, when you have peak level of euphoria, it doesn't take a lot to kick you down. Like, a good example of this is Rocket Lab. Like, Rocket Lab went up to almost 150. Now it's back down to the 60s. Now, why did it come down to the 60s? Well, because now it's doing the sympathy thing to SpaceX. SpaceX is down, so people are like, oh my God, the space economy is dead. Let's go back down. And Rocket Lab gets cut in half. Like, what changed between the last 30 days? Nothing. Nothing has changed. The business is still doing, you know, what it does. It still sends rockets into the air and basically does manufacturing and satellites and all that stuff. But the point is, the market has a way of overreacting to the upside, and then it also overreacts to the downside. It just depends on the narrative. I mean, we see this all the time with Robinhood. Robinhood will be like, oh my God, crypto volumes are down because, you know, there's crypto winter, and everyone's like, oh, Robinhood deserves to be $50 a share. And then Ethereum starts running and Bitcoin starts running. I was like, oh my God, Robinhood is the best thing in the world. This thing should be worth 200.
Yeah, but that actually does affect their numbers. Unlike, you know, the market sentiment doesn't affect Rocket Lab's metrics.
Well, no, it's narrative. I mean, the multiple does, though, right?
Sorry, what do you mean the multiple?
The multiple which people are willing to pay for that business does change, right? The more risk you layer on, the lower multiple.
Yeah, of course. Of course. But like, it's just, I think Robinhood is an interesting case just because, you know, if the market does crash, they might actually make less revenue and profit. Not just what you're willing to pay for it on the stock, but like, just if you've been a holder since, you know, the seed round, the earnings might go down.
Well, that's the thing. Like, and no one can really quantify just how much of the like, do you think a 10% reduction in Ethereum means that trading volumes are going to go down 80%? Like, no one can really tell. But the thing is, the market always has this way of overdoing to the downside and overdoing to the upside, where it could be up 10%. It was like, oh my God, trading volumes are going to explode. That means that Robinhood is going to freaking 5x from here. And the market just bids this thing up crazy high. And then when things go down 10%, it's the exact opposite, where people think, oh my God, this business is completely dead. And now they're going to start losing money on crypto. And then the market cuts Robinhood in half, right? So it's not so much that I agree or disagree with the direction. I don't like the breadth. And that's the best part about being a mean reversion investor, because when things overcorrect, you can make money. When things get overbought, you can make money, or you can stay out of something. Right. So I always, sorry, go ahead. Yeah.
No, I was just going to say, we got down to around like 81, I think, like really, really low prices on ServiceNow. But for the most part, and I don't know this to be true, but you were probably buying on the way down around this price. Like, it's been around here for a while.
Nah, I got my cost basis on most of my spread positions is very low. Like, I was able to somewhat bottom tick this. I bought in the 80s and some around in the 90s. Right.
So you've not bought any around this price?
Not really. I just, my position just got too big. Like,
okay, that's fair. But for new investors looking to get in, how do you see this price today? And what are the metrics that you're looking for that would, you know, aside from just beating Wall Street expectations, is there, you know, renewal rates or average customer value or something like this that you look to for ServiceNow? Like, what are the identifiers for you that they've had a good quarter?
So the first thing is how much of their future growth is going to be coming from this new AI stack that they have, right? So they have something called
And do they break that out?
Yes. Yeah. So as an example, last year they were originally expecting 500 million of ACV coming in from their AI product. Then they upped it to 1 billion. Now they're upped it last quarter to 1.5 billion of ACV, right? It could even go up higher again this year. So they've been very conservative with how much they're likely to generate from this, but this is actually becoming a really big business line for them. The really good tell for me that gave me a lot of confidence is that they, during their investor day, they explained what the target was for 2030. And they said, look, this is our number. This is what we're projecting, but this is actually a conservative number. And so, you know, when I look at it, you can kind of like use math to work your way backwards and say, okay, what is their growth rate going to be for the next 5 years? And what else have they done to kind of like get themselves, because they are a mature business. Like when you have a mature business, it's really, really hard to compound at the rate that these guys are compounding. Like doing a 20% year-over-year growth rate when you have a base of almost like $17 billion, it's not the easiest thing in the world. I mean, you gotta seriously like grow, right?
Yeah, yeah.
But the confidence that they had in a lot of what they were saying was very healthy. The other thing is they made some tuck-in acquisitions that basically expanded their total addressable market a little bit, where they already own a vast majority of the high level of ITSM. They included a cybersecurity company from Israel that they bought called Armis. That's, you know, everything works together, but you have to, like I said, be in the industry to understand what these guys are actually doing. So they've layered on different things that basically give them a lot of tools in the agentic world. So there are, you know, when you think about companies like Blockbuster, let's say Blockbuster had this business model where at one point Netflix said, please buy us. And they said no, because they refused to actually go with it, right? Like there are a lot of software companies, they have to make some hard decisions at times. And the thing is, if you don't make that hard decision and you lean into the new system, you can get left behind and you can get destroyed. I'll give you a good example of this in SaaS. Back in the day, back in like the 2000s, everyone used to use Adobe Photoshop and Premiere and all that stuff, right? So that's nothing new. But back in the day, you actually loaded software onto your computer. Like, you know, you basically bought the CD, you know, back in the day. You're not young, you're not old enough to, to ever had to do that.
Of course
You did that?
I'm 28. Of course. Of course. You download software.
Dude, when you didn't download software, you came in a CD. See, you don't even know.
Yes, no, I absolutely do. That's how we used to upload the Windows and everything.
You did that?
Yes, in a cream colored freaking computer.
I'm trying to think. Like it's 2026. What year did you do that?
Probably early 2000s.
When you were what, 3 years old?
No, not 2000. I mean, like, I don't know, 2006, 2005.
Yeah, but that means that you were 6 years old. No, like 8.
Yeah.
You were uploading.
Dude, I'm telling you, I was a computer kid. Like I was always like the first video game I ever played was RuneScape when I was 6. I was on the computer all the time.
Sorry. Like I said, I have a hard time believing anyone past like who wasn't like a teenager in the year 2000 knows anything about all this stuff. I mean, but you may be very well, you know, computerized. So maybe you know more than
I was playing Command and Conquer. Let's not question me too much.
Okay, well, whatever. The thing is, like back in there, you had to have CDs. You loaded it on, you know, and it came with a CD key, and you know, you did all this stuff. So back in the
really
day,
big boxes, the really big CD boxes with the massive manuals in it.
Okay, yeah. So you know at least somewhat. Adobe said, look, we're going to change that model. We are going to instead have you just download the application and connect to the internet. And every month you would pay a monthly subscription. There was an uproar among people saying, oh my God, like, what the hell? Like, we don't want to do this. Like, you know, this is blah, blah. Eventually people got it. Now, the reason why Adobe leaned into that, because they could have just said, no, we're going to keep the same thing that we have all the time. We're just basically going to load the application on your computer. We're not going to move into the cloud. We're not going to have shared resources. We're not going to do anything. We're not going to have, programmatic updates. And you know what would have happened? Their competitors would have killed them, right? What killed Blockbuster wasn't that their business model was dying. It's like that they just didn't pivot. Like they already had access to millions upon millions of customers. They could have said, look, if you want, we buy Netflix, we integrate Netflix into our system with their microservices. And now if you have a Blockbuster account, you can basically watch this movie on your TV and you don't have to go to the store. And they could have just sunset everything, right?
Yeah.
So right now, if ServiceNow said, no, we don't believe in AI, we're just basically going to sit back and we're just going to use IT, a competitor will come in with AI products that would kill you, that do exactly what I just said right now, but they would do it instead of you. And then eventually ServiceNow would go bye-bye, right? But this is the thing. So when you have a company that's dynamic, that can actually use its scale to actually integrate new things and bring them into its ecosystem, it makes it so that they will not only survive, but they'll actually thrive going forward because they own that customer relationship already. So if you can layer on all of these AI products, that means that all of these other guys, these guys that are saying, hey, I could do ITSM with AI, and they'll be like, well, I already have ServiceNow and I'm pretty happy with them. So why should I even go with you? Right? So it's sort of this thing where any company right now that's in the SaaS space, if they're not leaning into AI, they're cooked. Like they're done. Like unless you are a very, very regulated niche player where you don't really care about AI, and there's plenty of companies that are like that. If you are at the high level that is Adobe, is Workday, is ServiceNow, is Salesforce, you better be leaning into AI and you better be leaning into it hard to basically optimize every single thing you can to bring the most value to your customers. Because if you don't give the value to customers, you know what the customers are going to do? They're going to find alternatives to you. It's the same thing with Adobe, where right now Adobe, they could have just said, we're going to stay with the CD model, right?
Yeah.
But what would have happened is other competitors would have said, you know what, we have a cloud-based system where you can have unlimited storage of your projects, and we do regular updates and we do feature-rich updates, and you don't have to buy another CD, you don't have to download another thing. Like, no, everything just works very seamlessly, and people are happy, and people didn't really look for alternatives.
Yeah. Do you have a view on the software names that you think are not going to be fast enough to modernize and keep up with all these changes, and that you might actually be a little bit fearful that they won't adapt?
It's really hard to say right now. I mean, I did something. Let me just share it with you. I was watching this podcast about like 8 moats that a lot of software has. And just get my bookmarks and
is this a video that we're going to watch?
No. It's a
Here, you look for that. I need to pee real quick. You take care of my chat.
Go for it. What's up, guys? This is the Chris Patel channel now. We're taking over. This is going to be the 51st state, which I think is a stupid idea. Damn it. Where is it? Here it is. Unfortunately, guys, unless Tanner approves it, I can't share this with you, so I'll just have to talk to you. No porn, Chris. Yeah, I think software for a lot of people, if you work in a specific industry, just how difficult it is to remove certain softwares that you guys use regularly. This idea that everyone can just switch out of the thing that makes it work. It's very difficult. People are very, and especially businesses, they're very risk averse to trying new things unless the ROI is like so massive it's worth trying. right now, as long as these software companies, especially the ones that have those customer relationships, they're able to maintain that good customer relationship and give products that work, they'll be just fine. But check this out. Share the screen. Okay. So this is something called the depth profile. I basically vibe coded this. And what I mean by vibe coded, I just asked Claude to basically like use certain parameters that and that I found to be the most telling on whether or not a specific company is going to survive this current up and down in terms of SaaS. And I did it specifically for the SaaS companies that's out there, right? So if you look at, this is by market cap. So the number one is like, these are the different profiles. So these are the different moats. So right here, does the accumulated customer data make the product measurably better in a way that a competitor can't shortcut, right? So proprietary data compounds with usage, directly improves output, meaningful aggregate data sets, data is stored, not leveraged, the customer could export and lose nothing, right? So all of these things, the first thing is just a data moat. So as an example, like you see the data moat from Microsoft is only a 3.5, right? Because there are, like, you can take a file from, what is that thing called? From anything, from Microsoft, you could open it in Google browser, all that stuff. So the data is not necessarily a giant moat for Microsoft, but data is a very big moat for FICO, right? And it's also a big one for MSCI, because all of that data is something that's been stored, like for all of these people for their credit ratings. That is a impenetrable moat that FICO has right now, where they have credit profiles on all of these people. Same thing with MSCI. MSCI has all of this data on all of these companies. So anyone who thinks that they can vibe code themselves at MSCI, like, no, you've got literally like decades worth of corporate data that's sitting with them, right?
Okay, but,
then
but
you have,
who's doing that ranking, by the way? Is this just your ranking?
Yeah, this is just my ranking.
Okay.
Based on what I think, everything should be, right? So as an example, like CrowdStrike has data on every cybersecurity threat known to man right now, right? Because they've dealt with it. Another one is Synopsys. Synopsys is an EDA software system. Like now I'm going to have to take Synopsys and probably Cadence and put them down a little bit. And the reason why is because there's open source tooling that one of the Kimi blah, blah, blah used to create their own chip, right? So
yeah, K3.
Yeah, so that's something that I have to measure, like where this belongs. ADP is like that. So if you look at the companies that have the lowest moat in terms of data, are going to be companies like Freshworks and Five9 and some of these like Dropbox. Like Dropbox doesn't exactly have a lot of proprietary data, right?
But to be fair, based on your estimates.
Yes, based on my estimates. Okay. Yeah. So like I said, this is literally me saying like, okay, this is what I think. Like Wix right here, Wix has only got a 2.5% like thing for data. Like there's not a lot of proprietary data that sits in Wix. Now, these are like the different things. I'm not gonna go every single one of them, but the scoring system kind of helps you determine like, okay, what the moat should be on a combined basis. So you've got workflow, regulatory, because if you work in a regulated industry, that's very, that's there. You've got right here. So licensed or accredited status with multi-year approvals. So think of a Palantir. Palantir has a 5 out of 5 for regulatory. Why? Because they have government contracts that literally took years to get approved for that. So if you look at something like Palantir,
let's get to the meat and potatoes here. Yeah. Who's got the highest scores overall? That's what we all want to see, right?
Okay, so the highest one, all of them combined on aggregate, is Microsoft. Like Microsoft is daddy. Like you just distribution, like anything that you can think about, Microsoft is there. Like these guys are not going anywhere. The scale is 5 out of 5 for them. Like you cannot beat Microsoft's scale. Another one is Amadeus, which is like a travel tech company, right? That they're Synopsys, Cloudflare, Oracle, Intuit, right? So Intuit actually ranks pretty high. Toast is there because they actually have a huge amount of like workflow where they own the POS systems that, that people use.
Yeah.
So yeah, I mean, you tell me which ones you want to look at and I'll see if I can find it.
Well, yeah, I'm curious on some of your thoughts on Toast or Shopify there.
Yeah. So Shopify right now, one of the biggest moats that Shopify has is its distribution and its ecosystem, right? Like there's already so many third-party things that are built on Shopify. You can't get out of that. Like, you know, people have built like third-party applications are there. So when you're in a storefront, you've got this entire ecosystem of things that have been built on it. Like it's not easy to get away from Shopify. Like no one can just say, create a Shopify competitor. Like, no, there's huge moat around that business.
Yeah.
Same thing with Salesforce and Microsoft. Like ServiceNow is good, but it's only got a 4.5. ServiceNow actually beats them, you know? So.
Yeah. Yeah. This feels, I'll be honest with you, a little alt indexy, which I always like fear with, because it's like, there's so many thousands of internal components that to put it on a 5-star ranking is like, how the heck do we know? But I think it's a good practice to do anyway.
Yeah.
To think about these businesses. I just don't know how accurate it is.
I did the same. Well, that's the thing. It's up to the user, right?
Yeah.
A lot of times, like you have to be the determiner of what you think the moat should is. So as an example for me, when I looked at United Healthcare versus the other companies that were there, I said, the first thing is United Healthcare owns both sides of the customer relationship. They own both the provider side where they do, where they actually bill the insurances and everything else, but then they also own their own like hospital like systems and stuff like that. And then they have a software layer, they have a payments. So they're much more vertically integrated. So it's much harder to displace a company like United Healthcare than it is to displace a company like Elevance or even CVS. Like CVS is there too, because they've got their own like, PBM and all this other stuff. So like you have to sometimes like go into an industry and create different metrics that you think like, and this is very subjective, right? All of this stuff is always going to be subjective. When you're investing, everything is subjective. If you don't like, do you agree that Microsoft has a 5 out of 5 for workflow? I could think it's, hey, listen, I think that 90% of the Fortune 500, like not 90, I'd say 99% of Fortune 500, all of them run on Windows, right? Like, so I think that from a workflow end, everyone is always going to be on a Windows product. Everyone's going to be on Office. But here's the thing. I've also seen now Google starting to pick up on workspaces, and they're actually taking market share on the Office side. So maybe this 5 in about a few years doesn't need to be a 5 anymore. Maybe it needs to be a 4.5.
Yeah. Yeah.
So the thing is, a lot of this data has to be actively managed. So you have to constantly like move it around. Like it's not one of those things where, it's going to be static, because a company is going to operate and, they're going to put up different modes and they're going to take different modes down depending on how it is. So like as an example, when we said the whole thing with Synopsys and Cadence, in terms of like where they are in terms of their moat in data, maybe it's not as strong as I'm thinking right now because of what happened with Kimi. So I would downgrade them down a little bit. So
yeah.
So this is more of a living thing, and I would love for a company like, let's say, Gartner, or a company like what's another good one, like S&P Global, Forrester's to actually like rank based on this, but they don't do that. They're more on the side of they do their magic quadrant, right? Where they actually show you like who the market leaders are in a specific kind of industry, but they don't have a feature for moats. Like this is, like I said, this is something that I created. It's not, it's proprietary to me, but once again, it's also subjective to what I'm thinking, not necessarily what's real.
Yeah. That's fair. Can we, how much time do you have?
I've got time. What is it? 3:23.
About earnings this week, any names that you're interested in? We've got
ServiceNow. Shit.
ServiceNow, of course. Yeah. We've also have Google, Tesla, IBKR, Capital One, Intel, SAP. Anything interest you?
Well, SAP will be interesting to me because, once again, I'm looking into software because I think that there is going to be a rotation into software. Because I think what's happening is people are realizing like, hey, I have all of these gains in some of the semiconductor trade, and especially not smarter, but like more fundamental investors. There's a price floor that people are willing to buy things up, especially from a great business standpoint, even if there is a level of disruption. If the price gets too low, it doesn't matter. For them, it's like, look, this is just way too low for what I think. And so you sort of have this nice period of consolidation, and you get this nice happy move higher, right? But these earnings are a great like acid test on just how either confirmatory or how wrong the narrative is. So as an example, when United Healthcare, they came up with their earnings, the shit rocketed, right? Because people realized, wait a second, like they're actually profitable and they're doing really well. Their margins are recovering. Holy shit. This confirms that this company is not dead in the water. And so,
or AMC, I don't know if you saw that today.
Yeah. AMC is coming back a little bit right now, right? I looked at AMC before earnings. They still have a lot of debt on the balance sheet, which doesn't make it very attractive. The other thing is like
I'm just saying because it's up like 20%, like that. It might
look
not be dead comment is like.
Well, look how bombed out it is.
Yeah.
I mean, you're talking about scraping the bottom of the barrel with AMC, man. It's like $2 now.
Yeah, been a bit.
At this point, you're basically buying a very small equity stub to the debt that they have. But here's the thing: like, there could be a point where AMC could do really well under three circumstances. Number one is if people start going to the movie theaters more. If Hollywood, let's say, got their act together and we start to see a lot more blockbuster features come out that people really enjoy, that could be something that helps them propel a little bit higher. Their biggest challenge is going to be that debt that they have right now. Like, they have to get that debt down. Now, the only way to get that debt down is by paying it down via free cash flow and everything else. Right now, they're still, as far as I can tell, their free cash flow is still not that great. So the one thing that could help AMC a lot, believe it or not, is actually lower interest rates. Like, a lot of businesses, their multiples would expand, but that's a great thing to see a company's multiples expand. But I think more importantly is a lot of companies that are debt ridden, they're operating under the assumption that that debt is going to crush them in the next 5 years. So if there's any sort of relief on the debt side where that debt that's basically crippling their operating income, if that goes away, or at least that gets materially, like moved down, that means that there's more money for things like share buybacks and for dividends. And
what do you think about the debt loads that some of these Neocloud and infrastructure names are taking on? I'm thinking specifically CoreWeave, Oracle, NBIS now. Does this scare the crap out of you, or do you think that's par for the course?
I mean, it scares the shit out of Burry. And I can give you the reasoning why it scares the shit out of him. It's because this is kind of like the same thing that happened with oil and fracking. Like, me and Matt, we've spoke about it before, but basically what happens is whenever a new industry comes up, people overinvest on capital into a specific thing. And the challenge is the product that they sell is a commodity. Right. So right now they sell compute, like the business that these guys have on a very fundamental basis. Like, we can discuss how NBIS is a little bit different than CoreWeave, and, IREN is different from CoreWeave, and we could discuss all of that. But essentially their business is very simple. They have a data center, they load it up with GPUs, and they sell the compute, right? And basically people rent out that compute, and they have contracts. Like, you have a 5-year contract, a 3-year contract, 2-year, whatever. So
10 year in some cases,
10 year in some cases, or even 15. Like, we just saw this thing with IREN, like 15 year, right? Which is really cool because you get this huge visibility into it. The challenge that you run into, though, is that, like any business, it's very hard to predict if the next phase is going to have the same level of profitability as what we've seen in the past. So when oil was $100 a barrel, every fracking play in the country was profitable, and they were making double-digit margins. Like, everyone was happy. In 2015, I think 2016, is when the Saudis and OPEC got together and said, screw this shit. They lowered their prices, and they just started pumping like crazy. And what happened was all of these fracking companies who were making double-digit margins, oil went down from $100 a barrel to 60. And the break-evens for most of the fracking plays is $75. So at that point,
Sure.
like, you have a sunk cost. You spent all of this money on CapEx to basically buy the land, buy the fracking equipment, hire the crews, do all of this stuff. And now what are you going to do? Your unit economics were priced for oil at $100, but now all of a sudden oil is at $60 and you're below your break even. So now you're screwed. So Michael Burry's thesis is he thinks in the future we're going to be at a point where we're oversupplied with compute. And when we hit that point of oversupply, the GPU rental prices will collapse. And then what happens is that next layer of chip development, let's say Rubin, is going to be just so much better than the existing stuff that's out there. These guys are going to have a massive sunk cost where they're never going to be able to get their money out because they spend all of this money on, let's say, H100s, or they spend all of their money on Blackwells. And so you're basically sitting on obsolete infrastructure that you can't do anything with, right? So if you get the option of going to, let's say, a Vera Rubin, and it's 10 times better, way more cost efficient for generating tokens, then these guys are going to be obsolete. And Jensen has said this, by the way. Jensen said, look, when these guys come out, when this new stuff actually scales up, like Blackwell and Rubin comes up, good luck to anyone still holding on to H100s, right? Now,
well, I don't remember him saying that, but he definitely said, don't.
Oh, no, he said it. He
spend every dollar on our one infrastructure or one architecture.
Right, because that's exactly his point, that if you spend everything on the one right now, the ROI right now, by the way, that's the other complaint that Michael Burry says is like, look, initially you said that the depreciation was going to be 3 years and 4 years. Now you extended it to 4 and 5 years. And now some of them are saying, well, we can extend this thing to 6 years and we could still use the same GPU. Now, the reason why that's...
But have we seen any evidence that that's happening to the contrary, that GPUs are getting turned off?
So far, no. That's the thing that makes this a speculative move on his part. His logic is we are eventually going to see that, but we haven't seen it yet. Now, the thing is, I can't say for certain, is he right or wrong? Like, so far he's been wrong, right? Like, one of the things that that even I'm shocked at is just how popular the H100 still is, because there's just crazy amount of demand
for the Ampere.
But I think, but the thing that I think that really helped H100s a lot is that there was a really big step change in the amount of power and cooling that makes it so that there is a bottleneck in adopting Blackwells to the speed at which could theoretically replace a lot of those H100 workloads, right? So the key argument that Burry is making is that at some point, there's just going to be way too much supply and there is not going to be enough demand. And these guys are going to be sitting on all of this stuff that's basically doesn't even pay for its own debt, right? And the challenge is when you take on more debt, it's kind of like a hamster wheel, because now you need to make a certain level of return just to break even. And the thing is, the more debt that you layer on, which means that you need more and more break even. So the challenge that I'm not saying I agree with Burry, or nor am I disagreeing with him, is that these things are very hard to time, and Burry's been known to be
very hard to time.
He's been right in the direction, but he's been wrong in the timing. And if you look at the movie,
how has he been right on the direction?
I mean, he called the market crash in 2008, right? The housing crisis.
Okay, yeah, that's okay.
That was 2006. That was but that was before delinquencies, huh? He was right on during COVID. He went super long in COVID.
Oh no, I'm not saying that. I'm talking more along the lines of you. I thought we were on the topic of the artificial intelligence thing.
No, I'm saying that it's hard. Like right now, he's got a thesis. Okay, he's putting his money where his mouth is. Like he's right on Oracle. Look what happened to Oracle. He bought puts on Oracle. He's probably up double digits on them, right?
Right. I'm not talking about whether or not he can't make money. I'm sure he's doing fine right now because stocks are going up and down on a lot of that speculation. But in terms of his idea that the depreciation schedules are way too long, or that no one's willing to use the older chips once the newer ones have come out, or any of that speculation has not been proven true yet.
Yeah.
And it's a great headline, but like, when are we going to see that? And like you said, that's hard to time.
Yeah. Well, that's the thing.
5 years away.
Listen, that is how the cookie freaking crumbles, man. When you go to Vegas, look, you play long enough, you're going to win the jackpot. But the thing is, do you have enough of a bankroll to survive, keep playing for the next 5 years?
No, I know. Right? But if I was listening to Peter Schiff and Peter Schiff told me that gold is going to go up, I could be waiting a long time. And then whenever it happens, he can say that he was right.
Listen, that's exactly how the market works, though. You know, the question is, what do you think the timeline is?
Well, I'm not sure. This is the way that I'm thinking about it, and we talked about this last time. But the market, or the models have gotten increasingly more intelligent the more GPUs that we use to train them. We have not seen a model trained. GPT 5.5 is like one of the first really, really big step ups in models that were trained by Grace Blackwell. We are a long shot away from getting models that are trained on Vera Rubin. And we have essentially the blueprints to create the Rosa Feynmans. Major step ups of architecture. During those moments, I don't think that the models will be used to just make a better prompt or a better email. I think new industries will be created, like how Claude Cowork or Claude Code was created. I think there's going to be ways that we do financials different, the way that we do, I think different industries will get hit the smarter and smarter these models get. And while that happens, until I know how smart these models are going to get, I just have zero way to time when it's going to stop. So I think that we've seen no indication of slowdown just yet, personally. And until we see any indication of, trained models on Rosa Feynman or anything like this, I think that we're still years and years away.
I'm going to make a prediction. I think one day Nvidia is going to be $1 trillion company.
I know you've made that prediction. I didn't know if you were going to make it publicly. I'm glad you did.
No, I was going to say it. I think one day Nvidia is going to be $1 trillion company. That means that it's going to lose 80% of its market cap.
I think they do $1 trillion in buyback before that happens.
I think the reason why they're going to end up at $1 trillion valuation is because the cyclical nature of their business. I can't tell you when that cycle ends, though. And I think that's the hard part, right? This is the same challenge you run into with technically any cyclical industry. If there will be a point right now where Nvidia will cap out its top line growth, and when it caps out its top line growth, the multiple on the company is going to get re-rated to be more of a value company. And when it's a value company, I mean, dude, it's still when you say $1 trillion, it's still a freaking $1 trillion. Like, you need to generate a lot of money to be a value company at $1 trillion.
No, I know. I was thinking in my head, I was like, why don't you say 500 billion? Like, if the amount of chips produced goes back to where we were before, then this company could go even lower.
Yeah. But like I said, no one can accurately time when that's going to happen. The only thing I'll say is that the higher the price, the higher the multiple, the more likely it is that you're taking a risk that something slows down or something happens. Like, for me, I look at this and I ask myself, the first thing with Nvidia is, what are some of the moats that Nvidia has that make it what is this guy? Like, this is a 10-year cycle. The internet was a 20-year cycle. We're still in the internet cycle. But guess what? Did AOL survive that? Did freaking all of these companies that were tech companies not disappear? Like, so people need to stop assuming that just because we have a cycle. I think AI is a 1,000-year cycle. But that doesn't mean that I can guarantee that Nvidia is the guy that's going to be leading that cycle forever. Right? Nor do I think that we've got infinite money that people are just going to keep spending on chips. But
Nvidia is not a new company, though, right?
No, it's not.
This is not a flash in the pan pets.com.
No, no, of course not.
33-year business or something.
Yeah, but at the same time, the business model has proven to be a cyclical business, right? There are times where people have massive infrastructure build outs, and then there are times where that infrastructure is done and you just kind of have to digest the already existing infrastructure. And when the market sees that, they say, wait a second, what am I paying 15, 20 times earnings for a company that's earnings are not growing anymore? And they're only growing because they're buying back shares, and they can only buy back, what, like 3-4% of the right now at $25 billion. I mean, at 25 billion shares
sound high. There's like a lot of companies.
25 billion shares outstanding right now for Nvidia, right?
Yeah.
So let's say they generate how much in free cash flow per year?
I wouldn't know off the top of my head. 40 something billion, or no, sorry, that was per quarter. I can look it up.
Yeah. Chris is a secret Burry subscriber. No, I am a Burry subscriber. I like to hear differing opinions. I'm not one that's all about, okay, yeah, I'm just going to basically like turn off anyone who has a disagreeing point. Like, look, the worst mistake I think anyone can do is only listen to one side. You know, sorry, go ahead.
No, that's why I constantly have you on, because I don't agree with you on this. But I do want to hear your side. But 119 billion was last 12 months free cash flow.
So, and let's say they dedicated the entire free cash flow to buying back shares. What percentage of their
50% is what they said they're going to do. But yeah.
Right. So let's say they did that. What percentage of their shares would they be buying back?
What is that? 1%?
Right?
Yeah, but I don't know why that means. There's a lot of companies with shareholder yields that are lower than 1%.
Right, but that's the thing. In terms of growth rate, if your growth is slowing down and the buybacks are how you develop your yield, then because that's what people are going to do. They're going to rate your multiple way lower. If your growth, here's my question to you: what do you think Nvidia's growth rate is going to be 3 years from now?
This guy said, you guys are so wrong on Nvidia. Not you guys. We have two completely separate opinions.
Yeah, exactly. I don't even know how that even makes sense.
He's calling for 1 trillion. I'm calling for 10 trillion. You can't say you guys are so wrong.
Yeah. Like, we're literally like way too opposite.
We're polar opposites. But
can I just say some? I used to look at the comment section a lot, and I realized there are just so many people that have opinions that like I always try to read the comments to try to see like, okay, are there any opinions worth highlighting to bring value? And then I realized there's just a lot of people that write stuff for no reason. Like, that comment didn't even make any sense. Like, at least if you're commenting on something, just at least try to, create like some level of, disperse like validity in your comment. Like, you literally have two dudes arguing two different things, just saying you're both wrong.
Yeah. It's you know what though, even the 1% buyback, I think the important part is that I don't think that they're going to be stagnant at 119 or 120 billion in free cash flow. I think what they're about to post next quarter is 100% year-over-year growth. That's my hope. And mind you, I don't think many people have been able to guide for that. I remember whenever we had a conversation, it was like you, me, Amit, and Matt, and something on a podcast, and the growth had gotten down to like 55%. And you and Matt were kind of expecting that trend would continue. That like they're not going to get back up to these triple-digit rates, and then growth started to reaccelerate. So it's like, I don't want to be what I'm trying to predict is just how good are these models going to get. The models have not found any ceiling on intelligence. We've seen them get smarter. We've seen them lower in their cost. Businesses are happier to adopt. Kimi K3 you just saw is compute constrained. They're cutting off subscribers. They don't want to do that.
So my thinking, and this is the bear case, I won't even say bear case, but this is like the rational case that I'm going to try to communicate. The first thing is, you've got a bunch of these hyperscalers, while their CapEx is likely to keep growing, they're also spending more on their own chips now. Okay. Training is where Nvidia really owned the market, but now everything is moving towards inferencing, and inferencing is where you can use a lot more ASICs. So you're seeing these announcements every day. Meta, we're doing our own thing with Jalapeno. Google has their, TPUs. Amazon says we've got Trainium. Why? It's because every dollar that they don't spend on Nvidia, they retain that margin themselves. I mean, look, Nvidia's gross margins right now are 75%. Like, it's hard to be like, okay, yeah, I'm going to buy from you and then try to layer on my own margin while still competing against everyone else.
What's the alternative?
What do you mean? Their own stuff, their own ASICs.
But built by who?
Built by TSMC. Built
And
by
Broadcom.
Intel now. And Broadcom, yeah.
Yeah, and Broadcom has 70% margins.
But they're an IP-based business and they're not $5 trillion.
No, but what I'm saying is that the alternative to get your chips built somewhere else is not free. And
no, but it's way cheaper than what you currently offer directly with Nvidia.
I don't even really agree with that, but there's one thing.
So then
there's one
please
thing to do a
explain-
prototype. It's another thing to bring it to scale.
So then please explain to me how over the last year Nvidia has been roughly flat.
The market determines it to be flat. Nvidia's market share has grown over time.
Right, but tell me then. So then, why is the market flat for the year then?
Well, I think that people have a hard time valuing where it'll be in the future, but that doesn't make them right.
So you think the market is wrong. You think you're right.
I mean, literally at all times, I think that. Yeah, that's why.
That's what you're supposed to think. If you didn't think that, you just hang up your fucking hat. No, I agree.
Of course. But whenever Nvidia fell down to $88, I thought the market was wrong. A lot of people called me dumb in the chat. The market was wrong. And then, whenever I bet on SoFi at 31, I thought the market was wrong and I was the one that was wrong. But that's the way I'm betting.
For me, I think Nvidia is probably one of the best companies for a trader, because there are times where the narrative gets so overblown. And let me just show you, I've actually made this year on Nvidia. Let me see. It's not the biggest gain, but let's see. Okay, profit and loss. I've been trading Nvidia.
Yeah, I also think, Chris, why do you think
here? So for anyone thinks that oh no, I'm just literally bear all the time. No, anytime I see hey, there's opportunities, I'll jump in. I've made almost 50, 60 grand on Nvidia just basically trading it. So yeah. I think Nvidia is a lot more range bound this year. I actually made even more in my IRA, but I think Nvidia has the ability to compound a little bit, at 10% growth from here, right? Which still is pretty good annually, between 10 and 20%. But the thing is, there are times where Nvidia gets way too oversold, and that's when you kind of want to buy and then let the narrative kind of flip on itself, let the earnings come out, and then this thing goes back to its mean again. Right now, I think the target for Nvidia for me by the end of this year is 250. I think that's pretty reasonable to get to 250, right?
I mean, that's more than your 10 or 20% compound, but yeah.
Yeah. Well, it depends on your starting point. If you're starting at, 220, then yeah, that's 10%. But if you're starting at 200, it's a big difference, right? So last time we spoke, I said this thing will be 10, 15%. But let's say 250 is the top, probably 200 is the middle, and 175 is the base. For me, that's what I'm seeing. And I think every year that Nvidia keeps doing well, I think that base is going to move just a little bit higher. The top is going to move a little bit higher than that, right? Until, let's say, the narrative actually breaks and the entire system says, okay, look, we're done with GPUs and growth rate is down, then Nvidia, of course, will come down. But until then, dude, if you see Nvidia get totally oversold, you could take some risk and buy some of it, and basically when it goes up, sell some of it.
But every time that they grow at greater rates than what the market is giving them, the value, the multiple is coming down. So what is the bottom multiple for this stock? Do you think it gets Micron level prices where the forward P can get to 3 times or something like this? At some point, if they continue to grow at 40, 50, 60%, and margins stay high, which there's been zero sign to say otherwise.
Once again, I mean, you could fire up your Fiscal AI and look at the growth rate for the next 3 years. Bring it up, show everyone.
Okay, but that's forward estimates based on Wall Street numbers where they've been wrong on the last 12 or 13 quarters.
Yeah, but by how much? You're wrong like 5% up, 5% down, whatever. Who gives a shit? Well, you got at least right, but that's what I'm saying. Look at the numbers. Like if they're okay, if we're saying, oh my God, I think that Fiscal, like let's say Wall Street is going to be wrong in 2028 by, they're saying it's going to grow by 20% and they grow by 25%. They're wrong by like, that's still like 20%.
No. That's not how, hold on. You're like super, super wrong on this. So
okay, bring it up. Bring up Fiscal AI. Let's just see. Let's just see what the estimates are.
I know, but I can show you this. This is fine. But that's not how estimates work. So every quarter, whenever a company beats by their estimate, it's whatever the estimate was that day. But throughout earnings are raised from like if a company comes out and they say, hey, we think Micron's a $500 company, and then they triple their earnings estimate and bring the stock up to 1,500, the earnings beat is off the 1,500 number, not the 500 number. So companies can beat small on quarterly numbers by 4%, but they can beat on long-term numbers by 60, 70%.
Well, I agree with you. I totally agree with you. But the thing is, look at the base that you're running off of right now, right? So according to estimates, they're going to top out this quarter, and then they're going to make their decelerating move down, correct? Do me a favor. Load up annually for me.
Yeah.
Okay. So according to this, they're going to grow by 82% next year, right? So they went from 65 to 70 to 82. And then the year after that is going to be 42. And the year after that is going to be 23, right? So what would you pay for a company that's growing top line by 23%?
I mean, it all depends on the different business, but somewhere a little higher than market rates, like S&P 500 multiples.
Okay, and so what is the S&P multiple right now?
29 times, something like that.
29 times earnings, right?
Yeah.
What's Nvidia's projected? What's Nvidia's earnings projected to be in 2029? You scroll down and look at the EPS. See?
Oh, sorry. Do I have reverse? Here, wait one sec. I want to reverse these numbers. $16 for 2029.
Okay, so take $16 multiplied by 29. What do you get?
1606. 465.74.
Okay, so then there you go. That's your target by the end of 2029.
But I honestly don't think that we can guess what their earnings are going to be this far.
But you basically put a multiple on it. If you think it's going to be higher, give them a higher multiple.
Yeah, I know, but yes, right? I agree with you. But like, even whenever
you're the one that you're the one that determined the multiple, not me. So
no, I'm not saying 29 times is not correct. What I'm saying is like right here on this number right here, this estimate from Wall Street is lower than Nvidia's own numbers that they put out, which they always beat.
Okay.
I think that they'll beat 91 billion.
So here's my question to you. Do you have a model that shows what you think it's going to be?
I do. I have 93.5 this quarter. I don't know the last time I've updated it, so I'd be a little bit.
No, I'm saying a year out. I'm saying a year out and then another year out. Like, what do you think is going to be in 2020?
Yeah, I do, but it's not up to today, so I don't know if I would be a good model right now. But I do have a spreadsheet here. Forecast. So I have 93.5 and then 105 billion and then 120. So I'm that's just for the full year of 2026. So I'm slightly higher than Wall Street here. So 93.5 105, 120.
Okay. So, and what kind of margin do you think that they're going to have on those years?
Margin I have at a 55, 56% margin.
Okay. And that's net,
$2.15, 239, 277 EPS.
55 net.
Net income margin.
Net income margin. So 55%. You think that they're going to be able to retain 55% net income margins with that growth?
I mean, we can look historically what they've been up to, but they also have a mass amount. So the last quarter, oh, sorry, that's not what I wanted to show. I don't know why they call it net profit margin on this. I wish I could change it to net income margin. Last quarter, they did 71% margins and 63% margins. These are not normal. These are non-operating income.
Yeah, because they layered on equity gains. Yep.
Yeah. Mark-to-market gains. But they still have that. Like Q2 equity gains is going to be huge because of Intel, because of, all of these things. So they're still going to have a mass amount of that. But 55 to 56% is right in line with what they've done for the last 2 years.
Right. So that's what you're assuming. So 55%, which is right, which is fine. I agree with that. And your growth assumptions are how far away from the current up and down are your assumptions?
I haven't looked at the estimates in a while. I'm probably on the more, let's see. Yeah, so like next quarter, I'm sort of not in the middle, but I'm on the higher side. Like there's some estimates here for next quarter, 96 billion. That's way above 100% growth year over year. Like if they come in at 96.6, that would be wild. I don't think that this company, I know it's cyclical, but you have to admit this curve is much different than the times before it. That it's much longer.
Well, here's the, and this is just me saying this. At some point, we can have one of two things happen. The credit markets could refuse to finance a lot more of the data center build out, in which case now you've got Nvidia that's probably going to end up being impacted because they're basically sellers of that, that compute. So if the market sort of turns on you and the credit markets turn, then what happens to Nvidia?
I agree. Yeah. I mean, I could paint a bear case. I'm not saying that this is foolproof. I'm just saying, do you not think that there's a margin of safety baked into its price today?
I think in the short to medium term, there could be, but I think it's more fair value than it is aspirational value today. That doesn't mean I don't think it could be 250 by the end of this year. I think that's the target that I have, 250, and then probably 300 by the year after that, and then probably 350 the year after that. It's very simple, right? The only challenge is that is a moving target on what I think it could be, depending on, different circumstances that happen at the macro level. If interest rates, let's say, go up to 7-8% because Iran war situation gets out of hand and oil goes to 100, like guess what? Now all of a sudden interest rates are higher, which means that all the financing that has to be done by NBIS, CoreWeave, IREN, and all of these guys to build out this data center may or may not make sense economically.
Agreed. Agreed. But there's
all of
large
those things,
part of the equity markets that you would just want to avoid, not specifically Nvidia.
Oh, of course. But once again, because the valuation is where it is, you're going to have a different reaction to it. So if you've got a company that's already bombed out, that's down 70-80%, they don't have any debt on the balance sheet, and they're still growing their top line at, let's say, 20%, and it slows down to 18%, the impact on the stock is going to be a lot more muted than a company who's dependent on businesses buying its stuff, and they may not be able to afford to buy that stuff. That is the core argument that I think Burry is making right now, in that at some point the hyperscalers are going to cut back on their capex. And his estimate, from what I've been reading, is probably 2027 and 2028 is when they start rationalizing their capex and their free cash flow starts to grow again. And by that time,
based on what? He doesn't know. That's just
but you don't know it's gonna not happen either, right?
I know, but I think that there's a margin of safety. I'm not calling for a specific time where I think that this is going. I'm
I think
smart
what
enough to
also-
say I
what
don't know.
also-
And then
what
the Bears,
also-
they know.
Well, I mean, clearly you think something. You may not say it, but clearly you think that they're wrong. That's why you're in the stock. If you had no opinion on it, you wouldn't be in the stock.
No, well, I think we are constrained at almost every single level. We're bottlenecks, demand higher prices, and yet the stock prices are not adjusted. Like, we have certain areas of the markets, Lumentum, Intel. I don't know. I could probably think of some in the future, even Neoclouds and stuff that are quite highly priced. And then on the other side, in the exact same industry, you have the Microns, the Nvidias, and AMD is another one, very expensive. AMD. Below here is Nvidia, selling to the same customers, to the same market, all of this stuff priced very differently.
Yeah.
And yet we are going to have a bottleneck in land, in power, in photonics, in all of these different areas. But yet they're priced differently in the different sectors. And I think the one that has some of the highest growth of the highest, not like total number and the highest margins is Nvidia, and it's not being priced as one of the most expensive. I think that's a good offer.
Why do you think that is?
Well, I think one is it makes up for a large part of the S&P 500 already. I think there's retail doesn't want to buy a $5 trillion company. I'm not personally worried about that. And I think that a lot of people try to do the catch-up trades. The AMDs coming around, like these names, if you miss Tesla, you can get Lucid. If you miss Tesla, you can get Rivian. But to me,
I think you're giving retail a little bit too much credit. I don't think
I'm giving them much credit right now.
I don't think you're giving. I'm saying you're giving them too much credit on how much retail could move a company like Nvidia up or down. I think institutions have way more ability to do that. And I think institutions are saying this is a classic 15-20% growth compounder, but it's not one of those things where you're going to have like this crazy move up. So I think Nvidia probably is going to go higher from here, unless, of course, the news changes and everyone, but the market, like I said, has a way of factoring in a bear case that may not be there. And if Michael Burry can convince enough people that, hey, the growth is going to slow down in this CapEx cycle, then there's going to be people that are going to say, well, I shouldn't risk it, especially if I'm up so much already. Right.
Yeah.
So
yeah.
I'm personally of the mind that I think a 10-15% up move on Nvidia is very warranted because they are trading at much lower valuations today than they were last year, and the numbers have already kind of caught up. So could Nvidia move up a leg? Probably. But I also think that the market is just skittish right now. And the thing is, it doesn't help that every day when new news comes out that OpenAI is doing their own ASIC, Anthropic is doing their own ASIC, Anthropic is partnering with AMD, another company is partnering with Intel to do this, another company is doing this. What happens is people look at this and says, wait a second, maybe Nvidia
Chris,
is not the end all be all.
Come on. You do this thing where you go like, why do you think the market doesn't appreciate Nvidia? I take everything you're saying and apply it back to ServiceNow. Why is the market not appreciating ServiceNow? And then the whole Starbucks story, you said, well, that's noise. And I'm going to tell you that those stories that you're bringing up is noise. The market share in Nvidia is growing.
No, which is why you are an investor. That's why we have a differing opinion. I'm just giving you my case. You're giving your case, right?
I know.
I'm not disagreeing. I disagree. I'm trying to rationalize
do you
why
disagree
Nvidia
that they are growing in market share?
Depends on which one you're talking about. I think they're growing their market share. Well, first of all, I don't think that they're necessarily like losing any market share in the training side, as far as I can tell. And then on the inference side, I haven't really looked. But the thing is, the market itself is growing at such a fast pace on the inference side. So what percentage of market share did they have last year, and what is it this year?
I need to look at the exact amount, but this was a study that was just published by Brad Gerstner's team not long ago. I could send it to you. But I think they're at like 72% market share now or something like this. It was like 69% or something. I need to remember the exact numbers, but they're still growing. And you can see it in the margins. If people were worried about the margins, you'd see the margins come down.
And the inference pie is growing at an exponential pace right now.
And they've got a chip for that as well.
No, that's what I'm saying. That on one side, that is your bull case saying, look, if there was a slowdown in inference demand, then theoretically this thing could be going down because they'd be losing market share, right? That's not happening, right? They can still command all these premium prices and all the stuff that you're saying. Like I said, it's a point of disagreement. I think Nvidia, at some point, the growth is going to slow down significantly, and because inference demands will be will be met. I don't know when that's going to happen, and I think there's going to be a lot of players in the space, and that'll dilute their margins, and their margins will probably come down to their more historical 30-40%. I mean, that's my case for them. But until I see that, I think Nvidia is a great trade. Just wait until it gets oversold and buy it, and whenever it gets overbought, sell it, and enjoy the volatility. I mean, you could have done really well this year selling covered calls in Nvidia.
I did. I was selling.
You sold covered calls?
Oh,
good.
Yeah.
I'm happy for you. Perfect.
And on NBIS and some of those other names.
Good. I mean, I think if you're not selling covered calls in this crazy market with this much volatility, you're doing a disservice to yourself. Even if you're doing the most craziest, what is it called? Like strike, you're getting paid a really good premium.
Yeah. No, I was doing either 2 week out or 1 month out covered calls for all the big
what
AI
deltas,
names.
What deltas were you using?
I do low deltas. Anything that's like around under 0.2.
Oh, dude, that's. I mean, look, the good thing is, I like so high. You're still getting good money.
But as long as I don't have to deal with rolling it too often, I'm happy. And it was actually
now I know why. Now I know why you retired. You got this nice little freaking income stream coming in from YouTube, and you got this covered call income coming in.
I was writing some of the contracts for, or selling some of the contracts for Nvidia were like 240 strike prices. I was still making good money on them, like back whenever it was really high.
Yeah, that's
wild,
awesome, dude. Yeah.
Okay, I am way over time. The market actually closed while we were talking. Both markets, NASDAQ and S&P 500, ended up closing red today. Chris, I will put your link in the description. Once again, thank you for coming on. You're always more than welcome to join me at any point.
Let me know if you want to do like a regular segment like this, because I usually try to have a schedule, and I can just come on and we could just do maybe like 1 day a week or something, and we'll figure it out. Oh, thank you, Matt. Matt, did Matt donate 10 members or members per month? I think some people donated some money. If you want to give some shout outs, man.
Yeah, I was going to do a wrap up show, but I was going to kick you first.
Okay. Oh, okay. See you later.
We're going to X. I'll talk with you later, man. I'll wrap the show.
Take care. Later.
All right, man. Peace. So guys, that has been the first Monday episode of the new stream time. We are going to do 4-hour-long streams. Essentially, that's noon to 4 every single day. We won't go over, the time next time. I also almost finished this 32-ounce bottle. I think maybe that's going to be a stream goal. I can't end the stream until I finish the water, but let's see if I can. And by the way, I filled this before stream, so we'll get it down. That'll be a new stream goal, or else we can't end. I'm like just violently sick one day and I can't drink, but we are going to have constant segments, constant guests. We are going to have a second channel to bring a lot of those conversations, the Tevis conversation, the Chris conversation, my topics that I talked about on Palantir. If you weren't around, you can, you don't have to wait for the chapters to get updated. I will have a separate video uploaded on my comments around Palantir, some of these other names. There's going to be some fun other activities. Wait till Friday for something that I'm going to announce that should be very fun. A lot coming. Me and Marshall are here to take over. So thank you all so much for watching. Really do appreciate your time. But bye for now.